If you all enjoy the event, with no further ado, Charles Evans.
Thanks. All right, thanks very much. It's a great pleasure to be here. Today I'd like to briefly give you my outlook for the U.S. economy before discussing some long-term economic trends and my views of appropriate monetary policy. And let me note that my comments will reflect my own views and do not necessarily represent those of my colleagues on the Federal Open Market Committee or within the Federal Reserve System. I took the same way whether I'm voting any particular year or not. I have a slightly longer speech that's available than the remarks that I'm going to deliver this morning. I'm going to take the best parts of this speech to allow ample time for discussion. So I'll start my remarks with a discussion of my relatively optimistic outlook for the U.S. economy. I'll then talk about some underlying structural trends that imply that both growth and real interest rates in the U.S. will likely be lower in the long run than we thought they would be just a couple of years ago. And I'll finish with my views of appropriate monetary policy in the U.S. All right, so let me turn to the outlook for the U.S. I anticipate U.S. gross domestic product will grow in the range of 2 to 2.5% over the remainder of this year. After the sluggish first quarter annualized growth rate of 0.8% is accounted for, this would leave the increase in GDP for 2016 close to 2%, or about the same pace as in 2015. The U.S. consumer is the linchpin behind this relatively optimistic outlook. While consumer spending was somewhat soft last winter, it rebounded quite a bit in April, and the little data we have for May have been positive. The most important factor supporting household spending is the substantially improved labor market in the U.S. Over the past 2 years, the unemployment rate has fallen to 5%, half of its 2009 peak. And job growth has averaged 233,000 per month. These gains have raised incomes and buoyed confidence over future job prospects. Lower energy prices and accommodative monetary policy have provided additional support to the spending wherewithal of households. All of these factors should continue to generate solid increases in consumer spending, particularly given my assumption that interest rates will stay quite low for some time. There are, however, several factors weighing on economic activity in the U.S. The slowdown in global economic growth, notably in emerging market economies, and uncertainty about international prospects have contributed to a rising dollar and declining commodity prices since mid-2014. The trade-weighted dollar has appreciated about 20% since June 2014, while oil prices are down more than 50% over the same period. U.S. firms that sell their products in global markets and those exposed to commodity markets have felt the brunt of these relative price movements. All told, net exports have made noticeable negative contributions to U.S. growth in the past 2 years. Uncertainties over foreign prospects also have at times contributed to heightened volatility and some elevation in risk premia in U.S. financial markets. The associated tightening in credit conditions is weighing on domestic spending. Notably, in addition to falling energy prices and the rising dollar, tighter U.S. financial conditions probably contributed to especially weak business capital expenditures in late 2015 and early 2016. Since last winter, financial markets have calmed down and credit spreads have retreated. Oil prices have stabilized and the dollar has depreciated a bit. Of course, we need to keep in mind that to some degree this welcome reduction in headwinds was influenced by monetary policy communications, a point I will return to later this morning. Adding things up, I see growth in the U.S. recovering from the tepid first quarter and increasing in the range of 2 to 2.5% for the remainder of 2016 and into 2017. For reference, this pace is modestly stronger than my assessment of the underlying growth trend and should therefore support continued reduction in labor market slack. Now, how about our inflation objective? Well, the performance on this leg of the dual mandate has not been as good.
In January 2012, the FOMC set 2% PCE inflation as the explicit inflation target consistent with our price stability mandate. However, over the past 8 years, PCE inflation has averaged only 1.5%. Core PCE inflation also has run well below 2% for quite a long time. We did see some higher readings on core inflation early this year, but the last couple of monthly numbers were more subdued. Still, on a year-over-year basis, core inflation was 1.6% in April. That's up from the 1.3% pace that prevailed through most of last year. I am encouraged by this development, but not satisfied. We still have a ways to go before we're back to target. I am projecting core inflation to end 2016 at 1.6%. Further ahead, I see both core and total inflation moving up gradually to approach our 2% inflation target within the next 3 years. This path reflects the dissipating effects on consumer prices of earlier declines in energy prices and the appreciation in the dollar, as well as the influence of further improvements in labor markets and growth in economic activity. However, I see downside risks to the outlook for inflation. The recent pickup in core inflation could prove to reflect more temporary volatility than I had assumed, and we saw this happen in 2012. Or international developments may result in further declines in energy prices or greater appreciation of the dollar. Most worrisome to me is the risk that inflation expectations might drift lower. Here I find it troubling that the compensation for prospective inflation one can glean from a number of financial asset prices has fallen considerably over the past 2 years. More recently, some survey-based measures of inflation expectations, which had previously seemed unmovable, edged down to historically low levels. Although financial market inflation compensation and some survey measures of inflation expectations have risen a bit of late, they still remain at low. Before discussing the implications of this forecast for my views on appropriate monetary policy, let me briefly put my growth outlook in a longer-run context. By historical standards, my forecast of real GDP growth in the range of 2 to 2.5% might not seem particularly optimistic. It's in line with the average pace of growth since 2009, which is about 2.25%. By comparison, over the previous 3 expansions, real GDP growth averaged closer to an annual rate of 3.5%. The decline from 3.5% growth to 2.25% makes one sit back and take notice. In the version of the speech available on the website, I go into more detail about the trends underlying this. One is that labor force growth has been declining. Another is that the demographics of population in the U.S. is aging, moving from over age 65 over the next 10 years from 15% to 19%. The contribution of labor input to growth is going to be less. Because of that, the quality is not going to be increasing the way that it had in previous years as well. And productivity is likely to be declining as opposed to the increase that we saw from 1995 to 2000. Productivity and potential output growth are also influenced by the amount and quality of the capital that workers use in the production of goods and services. Since the recession ended, business investment in structures, equipment, and intellectual property has grown somewhat more slowly than in other recent expansions. And when you consider that this comes on the heels of huge declines in investment during the Great Recession, the level of spending and the associated growth rate in the productive capital stock per worker, what we refer to as capital deepening, are very low. This reduced pace of capital formation also translates into lower growth and potential output. With low interest rates and plenty of cash on hand, firms might be expected to invest more. Instead, businesses are opting to restructure debt or return money to shareholders by issuing dividends or buying back stock. In my position, I have an opportunity to speak to a broad cross-section of business executives and learn firsthand about the issues they face. Of course, it's difficult to generalize, but one persistent theme I hear is that firms feel their productive capacity is about right-sized to the current level of demand, and their modest baseline expectations for growth in sales. Another common theme is that businesses are very attentive to what could go wrong with their plans. The greater weight they put on costly downside scenarios, the more reluctant they will be to commit funding to a long-run capital expansion project. Of course, businesses are also going to be less enthusiastic to spend if technological advancement truly has slowed, so that new capital won't be all that more productive than current capacity. It remains to be seen if the slowdown in productivity growth is temporary or longer lasting. That said, the notion that longer-run potential growth is slowing is a view that's been gaining traction. Now let me turn to monetary policy. An important element in the Federal Reserve communications is our well-known FOMC dot chart. Quarterly, each of the 17 FOMC participants submits his or her projections of key economic variables, along with assumptions for the appropriate monetary policy path that underlies those forecasts. These are published in what is known as the FOMC's Summary of Economic Projections, or SEP. The dot chart is found in the SEP. Each dot shows a participant's view of the appropriate target federal funds rate at the end of the next 3 years and in the longer run. The chart I'm showing today reflects our views as of last March's FOMC meeting. The next dot chart will be published after our upcoming meeting on June 14th and 15th. Focus for a moment on the median of the policy projections, and the median is indicated by the red dots, if you can make those out. In March, the median participant thought 2 rate hikes would be appropriate over the remainder of this year, where rate hike is 25 basis points. The median FOMC participant expected an additional 100 basis points or so of tightening in 2017 and again in 2018. By historical standards, this is a very gradual path. It is even slower than the so-called measured pace of increases over the 2004 to 2006 policy tightening cycle. That was 25 basis points per meeting, 17 meetings in a row. And that was steep compared to this one. One reason for this slow adjustment is the view among many participants that the neutral level of the federal funds rate today is even lower than its eventual long-run level that I just discussed. Indeed, by some estimates, given the variety of headwinds faced by the U.S. economy, the equilibrium inflation-adjusted rate is currently near zero. The degree of accommodation in actual policy needs to be judged against this benchmark. So the 75 to 100 basis point range for the nominal federal funds rate expected at the end of 2016 by the median SEP forecast may not be terribly far from neutral. The equilibrium real rate should rise gradually as the headwinds fade over time. And as it does, the benchmark to judge policy accommodation will also rise. But this is likely to be a slow adjustment. Even in 2018, the dots aren't back up to their long-run range, and the SEP forecasts for unemployment are generally lower than their long-run levels, and inflation is projected to be at its 2% target. So slight headwinds are expected to remain even in 2018. That's why the median dot is below the longer run. I now want to spend some time talking about the dispersion in the SEP dots. As you can see, 9 participants agreed with the median forecast of 2 rate increases in 2016. And this is a strong consensus. Still, 7 FOMC participants thought the federal funds rate at the end of this year should be higher than the median. As Fed speakers began talking after our April FOMC meeting, some news accounts suggested there had been a significant shift in Fed sentiment. The commentary covering these speakers emphasized arguments for more aggressive tightening than that represented by the median. Now, if you find this confusing, I have a simple piece of advice. Before you infer that the consensus has shifted so quickly, count to 7 first. Clearly, each individual's policy view depends on his or her baseline forecast and perception of risk to that outlook. Naturally, these forecasts and risks will differ among participants. This is a feature of a healthy policy debate. Some analysts complain that the dispersion of dots clouds the FOMC's policy message, and some advocate eliminating the dot chart entirely. I disagree. The dots put on full display our robust policy discussions and differences of opinion. This adds value. Since policy assumptions are so critical for economic projections, omitting the dots would be pulling down a curtain to remove from view participants' broad judgments relating to the range of issues surrounding our policy deliberations. Instead, our transparency conveys important information to the public. The individual SEP projections are without attribution. We don't identify ourselves. So there are many untold stories behind the dots. But an individual's public discourse often provides a good idea of that particular FOMC participant's policy rationale. After all, there were 7 people who thought that the funds rate by the end of 2016 should be increased more than just 2 rate increases. They've got their own outlook to tell. There's also useful information in the portion of the FOMC minutes describing the SEP, including discussion that goes some way toward connecting the dots. So while not perfect, the SEP dot chart and associated commentary provide very useful indications of the range of potential FOMC policy actions. And in the end, the actual FOMC policy decision reflects a consensus-building process among these different views. Once made, this consensus is clearly communicated in the post-meeting statement, the chair's press conference, meeting minutes, and speeches by Federal Reserve officials. These tell you where the weight of the committee stands. Now, as I mentioned, the chart I'm showing you is from March. The next one will come out after our FOMC meeting 2 weeks from now. I can't tell you what that dot chart will look like. The information we've received since March could change some participants' forecasts and risk assessments in a way that will change their views of appropriate policy. But I can't talk about how I'm thinking about the process. And frankly, I'm really of 2 minds at the moment. And I expect to take this quandary with me into the next FOMC meeting. On the one hand, under the committee's current approach to renormalizing policy, I think it may be appropriate to have 2 25 basis point moves between now and the end of the year. I see the value in making small and gradual adjustments to the Fed funds rate as the data improve and confirm my positive baseline outlook for the U.S. And this is my base case view of appropriate policy. But on the other hand, if I think outside of the baseline towards my downside risks, I also think that a reasonable case can be made for holding off increasing the funds rate until core inflation actually gets to 2% on a sustainable basis. Let me explain my thinking behind these 2 views. First, I'll give the rationale behind supporting 2 rate hikes this year. As I noted earlier, I see growth picking up to the 2 to 2.5% range for the rest of this year and next, and inflation gradually returning to target. This is essentially the forecast I had in March and in April, and it is conditioned on a policy path that is broadly consistent with the median portion of the March SEP dot chart. The FOMC began policy renormalization last December because the committee judged it had sufficient confidence in continued U.S. growth and in inflation rising to 2% over the medium term. These were the preconditions we'd set for liftoff. But in March, in the face of strong first quarter headwinds, it seemed appropriate to delay the next move and monitor developments. Since our March meeting, the data have improved, and 2 rate increases this year could be viewed as just confirming our earlier expectations for a gradual renormalization, conditional on a solid economic outlook with confidence in inflation firming. I see recent data improvements as largely in line with my March baseline economic forecast, notably the pullback in risk spreads and market volatility that have occurred since mid-February provide important support to my outlook for growth. I believe not raising rates in March and April and the FOMC's communication of a more gradual path for the Fed funds rate contributed significantly to the improvement in financial conditions. So any move toward more aggressive tightening than 2 25 basis point moves in 2016 would risk undoing these positive developments. I view risk management issues to be of great importance today. As I noted earlier, I still see the risks as weighted to the downside for both my growth and inflation outlooks. And given that the Fed funds rate is still barely above its effective lower bound, policy is much better positioned to counter unexpected strength than to address downside shocks. So I still judge that risk management arguments continue to favor providing more accommodation than usual to deliver an extra boost to aggregate demand. Such a boost would provide a buffer against possible future downside shocks that might otherwise drive us back to the effective lower bound. Focusing more on risk management brings me to a second policy option. One can advance risk management arguments further and come up with a reasonable case for holding off increasing the funds rate for much longer, namely until core inflation actually gets to 2% on a sustainable basis. The past several years have been a period of disinflationary pressures around the world. Global monetary policies have responded, albeit with unwelcome delays in some cases. In the U.S., we have experienced an unsatisfactory, slow crawl back toward 2% inflation. We have a symmetric inflation objective, and we have undershot it for so long that the public's belief in our commitment to that objective seems undervalued. Just look at the survey and market measures of long-term inflation expectations. In order to ensure confidence that the U.S. will get to 2% inflation, it may be best to hold off raising interest rates until core inflation is actually at 2%. The downside inflation risks seem big. Losing credibility on the downside would make it all that more difficult to ever reach our inflation target. The upside risks on inflation seem smaller. Currently, financial market bets on core inflation rising above 2.5% are well out of the money. That's just half a percentage point above our target, and symmetric inflation targeting central banks will experience inflation deviations of 1 percentage point or more periodically. After all, we've certainly experienced this magnitude deviation on the downside in the U.S., even for core inflation measures. The question is whether such upside risks would increase substantially under a policy of holding the funds rate at its current level until core inflation returned to 2%. I just don't see it. Given the shallow path of market policy expectations today, there's a good argument that inflationary risks would not become serious even under this alternative policy threshold. And when inflation rises above 2%, as it inevitably will at some point, the FOMC knows how to respond and will do so to provide the necessary, more restrictive financial conditions to keep inflation near our price stability objective. So these are the two potential policy options that have some attraction from my perspective. And of course, I'm sure other FOMC participants have additional thoughts, as well as everyone here today. I can't say I know how our policy deliberations will come out, but I can confidently predict that we will have a healthy discussion of all of the issues. There is a lot to mull over, and I can guarantee my colleagues and I will be preparing hard and thinking deeply about the tough issues facing the committee today. Let me close with one final prediction. Our robust discussions will be evident in our June dot chart. Thanks for your attention. I look forward to your questions.
I'll take the moderator's privilege and ask the first question, which is really about the part of the speech we missed, which is you point out that your 2 to 2.5% forecast is above your view of long-term potential at this point. It seems to me that the Fed and the modeling world are way ahead of the street on figuring out that potential growth is much lower. and that this is part of what's playing out in terms of inflation expectations possibly ratcheting down. In your view on where potential is, I mean, I guess the real question is, what is the next step that would lead to an improvement in productivity that would break the long-term trends of demographics, et cetera?
Well, so it looks like, as I mentioned, ignoring the most recent cycle, if you look at the 3 previous expansions, the period where the economy was growing, the average growth rate over those 3 expansions was 3.5%. And we've been seeing something this time as 2.25%. Those other periods of expansions were times of very strong labor input. More people were coming into the workforce, it was expanding. Female labor force participation was increasing, and so that was adding another dimension to that. On top of that, the quality of labor was continuing to increase year after year as people with more education and job experience were staying on the job and adding to output even with the same labor input. Productivity was rising. Beginning in '95, we saw productivity increase dramatically, 95 to 2000. It was located primarily in capital embodied technology, the capital equipment that was put in place with digital electronics and numerically controlled machinery and computers were becoming more and more productive. And then after 2000, after everybody had bought more computers than they probably needed due to Y2K and all of that, and we stopped, we had an investment-led recession, we found that TFP increased dramatically, which I interpret as business process improvements finding their way into production technology. And so productivity continued to be growing as strongly during that 5-year period in the first half of the 2000s as during the late 90s. And we had asked ourselves, well, is this a new era? Is this stronger productivity? Is this going to lead to more potential output growth? And apparently it looks as if it was a one-off. And now we're reverting back in productivity sense to the previous slow productivity growth period, 73 to 95. TFP, which is always the unknown, unexplained residual, supposedly due to all the research and development, but it's hard to find those effects actually in the data in a strong, significant fashion. Apparently is reverting back to what it was before. Is it partly regulation? Who knows? But it's also the case that capital deepening, as I mentioned in the speech, has really declined dramatically. Investment was very slow during the recovery. So all of those things come together with reduced labor input through labor force participation falling and all of that. Now, we shouldn't be too surprised by this in the sense that looking around the rest of the world, we still are looking at growth rates which are among the highest of advanced economies, not the emerging market economies, of course. And so it's just, do you just expect that we could achieve 3 or 4%? I mean, to do that, we have to bring more labor into the workforce somehow, or we need productivity, and we need both of those, not just one or the other, all of that. So those are tremendous challenges, and even with better public policies that somehow incent stronger productivity and technology advance, you also need that labor increase in order to get very strong growth. So I think this is the world that we're looking at going forward, and standard growth models are going to have an implication that sustainable real interest rates are going to be lower because of that, and that contributes to the more challenging monetary policy environment, at least in terms of the amount of capacity to lower rates.
Yes, sir. Right here in front.
Okay, that's good.
We have growth, productivity, inflation, interest rates, all at approximately 2%, plus or minus. If you say it fast, you get the impression that you're predicting 5% growth. I don't think you are. You see, so that the confusion there leaves me with 2 quandaries. Do you really have the capability to put interest rates in any place you please? when you say you're inflation targeting, do you have the capability to target? Now, on the other hand, do you have the capability to stop inflation? Volcker killed inflation, all right. Do you have that degree of independence?
Well, I take as given that we're the monetary authority, and it's our primary responsibility that nobody else has in order to control inflation. And for the longest time, we never identified what our preference was for inflation. That wasn't really very important for a long period of time when you knew that inflation was too high and you knew that it should be lower. So lower inflation was always, an objective, starting out with Volcker from 79 to 80, and he got it down from double-digit inflation, and then on his way out, inflation was about 4%. And 4% was still largely viewed as too high, and we should bring it down. And then inflation targeting banks that have bigger problems put in place regimes, and they brought inflation down. It wasn't until about 2003 that the FOMC found itself making an announcement in May of 2003 that, there's a small chance that inflation could be uncomfortably low. It was the first acknowledgement of the FOMC that there was sort of a two-sided risk to inflation. But I take it as given, and so then it suddenly became more useful to sort of identify what our inflation objective was. And after quite a lot of deliberation, the committee agreed in January 2012 that we would target 2% PCE inflation. Well, it's the job of the central bank to deliver low and stable inflation. Fiscal authorities can't do that. And I don't really agree with the idea that we shouldn't be, that we can't fight high inflation or we can't bring inflation up or something. We're the ones who are in charge of this. So if inflation were running at 5% and we put up our hands and said, I can't do anything about this, that would be sort of like the 70s, and that's how you get the 10% inflation. I think the same problem is evident when you got 1.5% inflation. You say you want it to be higher, and I can't do anything about this. It's just going to stay low. Japan found themselves in that situation, and they're still struggling with it. I was on a panel in 2010 at the Boston Fed, and a former Bank of Japan official made comments, and he basically said, whatever you guys do, you don't want to find yourself in a position like we're in, because then you're going to throw your hands up and not know what to do. And now Europe is in this situation. So I think it's very important to get inflation up. And then what growth is and what real interest rates are, we have to be mindful and aware of what the structural underpinnings of the economy are so that we can adjust nominal policies in order to hit our inflation objective.
Paul?
Thank you. Charles, there certainly will be a recession at some point in the future, and your outlook would seem to think you might have a higher subjective probability of that than the consensus. In all the recessions in the last 40, 50 years, the Federal Reserve has cut the federal funds rate by at least 400 basis points. And the markets in those previous cycles knew that the Federal Reserve would and could cut short-term interest rates by a large amount. The market right now does not know how the Fed would or could respond to the next recession. Negative interest rates, massive QE, purchase of other assets, who knows? Is that a problem? Shouldn't the central bank have a sort of a public contingency plan for that next recession?
Well, I don't view myself as having, a higher subjective probability assessment that, we're likely to have a recession anytime soon. My own view is that, I'm fairly optimistic. I think there are downside risks. Obviously, downside risks could come about, and then that would create difficulties for the growth path. So that's absolutely right. But I do think that the fundamental underpinnings continue to be good. And I think that we're in a slow expansion period, and I would be reluctant to take away important underpinnings for that growth path, and I think financial accommodation is part of that. Now, the part of your question about previous Fed easing is a very interesting question. You're absolutely right that if you go back, to each period where the business cycle turned, the Fed cut interest rates by over 400 basis points. I think in many cases 500, or more than that. In 2000. The funds rate, I think, was at 6.5%. We went down to 1% when we were done by that. The previous one was even more than that. Now, one thing you should keep in mind, though, was each of those episodes were periods where the Fed was trying to have policy a bit tighter. It was intended to be tighter than its rest point. So when you start tighter than the sustainable level, then you're going to bring it down. You're going to bring it down even more. Some people have characterized it differently. Same idea that expansions end when the Fed has killed them, and after you're done with trying to rein things in, then you have to drop that a lot. I would say that the current expansion doesn't fall into that category. We're seriously trying to actively provide accommodation. If we found ourselves at a point like this where we don't have a lot of capacity, well, this would be an episode where it wasn't tight financial conditions that were leading to this per se, it would be other factors. One would hope that other public policy makers in other branches of the government and cooperatively abroad could play a stronger role. So I think that the real force of your question is to point out that it's not the Fed alone that can do as much as we've been called upon to do in the past if we found ourselves in circumstances like this. Other actors should step up. Now, if we did find ourselves like that, I do take, some measure of confidence from our previous QE episodes that those were helpful for advancing, easing financial conditions, and I tend to be thinking along those lines.
The woman in the red shirt in the back.
Sure. How concerned are you and your colleagues about the fact that the market is quite behind the Fed? Is it a credibility gap, or is it just that the market is pricing more of your downside scenario to? Any thoughts on that?
Well, I think it is important to recognize that the market expectations path is a slightly different object than what our dot chart is. Our dot chart is basically a modal forecast, our most likely scenario that each of us write down for GDP growth, the unemployment rate, inflation. And this is displaying the monetary policy that is essential for helping provide the underpinning for that growth forecast and control inflation. So this is our baseline scenario. Market expectations have to be pricing in all kinds of other events. It's much more of an unconditional path. So I've read some analyses, and this is dated, so I don't know what the numbers are for this now, but I've read some analyses where the market path is being held down in part because they're pricing in something like, this part I don't know, 20% probability that something bad is going to happen and policy would have to go back to the zero lower bound. None of that is in our modal forecast, because it's the modal forecast. That's part of it. Another part of it I've seen is the market expectation isn't exactly the expected funds rate, but it's got compensation for risk in there as well. And if you look at a affine term structure model and try to take out the compensation versus the expectation, then that moves it a little closer up to where we are. That being said, there are distinct differences in the market views on this. You asked if anyone is sad about that. I can't read my colleagues on that. I think you could probably read some commentary from speeches where they might be talking at this object more than I am. I take it as a data point and some indicator of what financial conditions are likely to be.
Timo?
Thank you. I have 2 points related to this, I think, fairly essential point in your analysis. That is, what is the potential GDP growth, and how you in a way, value what we have seen during the present recovery. The first relates to the fact that the public spending has been in this, or in the first years of the present recovery, it has been in a way reducing the growth rate of aggregate GDP. Whereas if you look at the private end product GDP, it has been increasing much more in a better way, close to, I just try to recall a chart which Eric Rosenberg showed some time ago, that it could be in the range of 3% or so. My other point relates to, in a way, our ability to measure GDP. I think it has been, in a way, being worse and worse as far as development has proceeded during past years due to technological change, due to intangible investments, knowledge-based investments, which you don't see properly in GDP. And in a way, I talk about similar issue that we had with CPI indices in earlier years, where we saw that okay, the quality aspect was not led to a situation where the actual CIP numbers tended to overestimate the actual inflation. Here it's in to opposite direction. So could you please evaluate these issues? Thank you.
Well, evaluation would take me much too long. I'll offer an opinion on these things. Let's see, first off, your question about fiscal policy and things like that reminds me of previous conversations where the recovery, coming out of the downturn has been remarkably shallow, very slow, and people would say, how come we didn't get a V-shaped recovery? How come we didn't get a V-shaped recovery like in the 80s? Because in the 80s, we saw, a sharp downturn in the economy. Unemployment spiked to 10%, quite comparable to what we saw this time. But then we saw it turn around and we saw extraordinarily strong growth after that, and unemployment came down. Well, what are some of the differences? Well, one was fiscal policy was dramatically different. There was an enormous tax cut when the Reagan administration came in. Government spending increased dramatically. Military spending increased dramatically. And so if you compare government spending and fiscal impetus through the 80s and its contribution to that V-shaped recovery, it's very strong compared to what we saw in this time, even with the extraordinarily modest, what seemed like by $787 billion of stimulus. It ended up not being nearly as productive when the state and local governments took their part of that and didn't do stimulative things with that, but saved a lot of that. So I'm agreeing with you that it was not helpful as much this time, and that's part of the differences. Now, when it comes to measuring GDP and quality and technology improvements and things like that, I admit that I can't say I know that we measure it exactly right. There are definitely challenges. It takes time to sort of figure out the best way to measure these things. But our job is somewhat easier than perhaps your jobs or the jobs at the fiscal authorities, the budget authorities, where it's much more important to actually measure GDP, have that viewpoint. What we need to do, in my opinion, as a central bank is form an opinion as to what the structural underpinnings are for the economy. And we can do this without necessarily having an absolute perfect opinion about how to measure GDP, because we get to see employment growth, we get to see other components of this. And what we're looking for is to make sure that in order to keep inflation within where it's supposed to be relative to our objective, we're not providing unbounded amounts of accommodation that would lead us to excessive inflation, nor completely inadequate, which would keep inflation too low. So by looking at that combination of how inflation is responding relative to what we're providing and what the economy is doing, and being willing to revise our opinion, perhaps the natural unemployment, another difficult concept to measure, but when we're measuring all of these things, potential trend growth, the natural rate of unemployment, and inflation, and how close it is to our objective, we get a lot of correlated information that tell us whether or not we have properly accommodated policy or not enough. And that helps us do our job. It doesn't necessarily answer all of your questions. And inflation is another variable that you could ask if it's measured properly. And there, I also take some comfort from looking at Treasury yield curve and knowing that investors have to be wary of not being compensated for inflation risks and knowing what inflation is. So even if I can't point to the perfect price index that measures inflation, somehow they're pricing something that they think is enough to compensate them for their risk. And fortunately, it aligns reasonably well with what we're trying to target.
Well, I know there's still a lot of hands up, but unfortunately we've run through our time, so that's always a good indication that the speaker was well received. We'd like to thank him and just have a round of applause. We'll bring up our next panel.
Call up Graham and Christian to the panel here. I'm Don Rissmiller. I'm the Vice Chair of Programs at the Global Interdependence Center. I work for Strategas Research in New York City. And I get to moderate the panel today on European issues. In particular, we're going to talk about Brexit, the European economic and financial outlook. So I'm going to be joined by two individuals, Graham Bishop and Christian Kastrup. Let me first say hello to Graham. He's an independent consultant on EU integration. His expertise spans the political, financial, economic, and budgetary matters. He's been a member of many European Commission expert groups and committees. We also have Christian here, the director of the Policy Studies branch of the Economics Department of the OECD. He was formerly the deputy director for economics and strategy for public finance and macroeconomics in the Federal Ministry of Finance in Berlin, Germany. So why don't I ask Graham to start us off and give us his view.
Would you like to speak for it?
Yes, thank you very much. Great pleasure to be here and to be able to talk about Brexit a little bit. And I think the first thing is, I'm sure Christian's going to talk about the idea of the European economy recovering steadily, 2% growth just under. Is that enough? No, it isn't. At that point it remains at 10, maybe just ticks down a little bit. But that's what we know if Remain happens. Britain remains in and remains a full and active participant in the EU. I hope, actually, that I obviously see my badge, I'm very much in the favour of Britain remaining in. So I hope that we will, and that there will be a strong, a large turnout and a strong vote to remain. And then a lot of this will be put to bed for a long time. If the UK does that, then Capital Market Union, CMU, is going to be a huge commercial opportunity for the city. Oh, right. Yeah, okay, right. So back in action. CMU is a huge commercial opportunity for the city. As the banking system of Europe shrinks its balance sheet somewhat and securitizes some part of that and sells it through the securities markets, that is a great opportunity here, both to issue the securities, to clear and settle them, etc., and to then manage them. So huge business opportunity, which should mean that as far as the UK is concerned, the city can continue these dramatic foreign exchange earnings and tax revenues into the UK government's coffers. So that's what we know at the moment as a path forward and a bright outlook for the city in particular. But the question then is what happens if this doesn't happen, and what might make it not happen. Now, I'm not going to go on about opinion polls. I'm sure you've all read them. It's too close to call. And there's a difference between the telephone polls and the online polls, and who knows what this really means. It is far too close. And the question of turnout is critical. We know that younger voters are far more positive, and I see that in the speeches I give, but will they actually turn out to vote? And the record is no. On the other hand, the older people who are more negative, people even older than me, more negative, they do turn out to vote because they always aim to protect their pensions, etc., by turning out and vote. So we have a snag. Now the other thing which has been borne in on me very strongly, I go out and walk around the streets of Bexhill and Battle on the south coast. I live in Battle, where the Battle of Hastings was fought, so a real chunk of Britain, and I go and see people on the streets. I don't wait for them to come to me when I'm giving a speech or something. I go and talk to them as they walk along. And try doing that. It is a shock, a real shock. The venom, the anger of people, many of whom are the victims of globalization. These are the C2D social categories with, shall I say, limited education, not secondary education or tertiary. They are very angry with people like me, and they make it apparent. I've been canvassing politically for half a century now. Yes, thinking about that. And I have never had people be so rude and aggressive to me. This is like a civil war. So just have no illusions about how violent opinion is. Now, the other thing about these people who announce that they're going to leave, I ask them, why are they going to leave? And they don't know. I want out. Immigration. In Battle, there are no immigrants. But that's the thing, they all say, I want to leave because of immigration. There may be a few, but it's not a problem. So there is this element which has been called up, these nasties brought up from the deep of immigration and frankly racism as well. It's not going to go away, the genie's out of the bottle, it's there. Now what these people, and I think David Cameron got the lash of this yesterday when he was interviewed on Sky, the idea that it's scaremongering. Whatever negative you say, you're scaremongering, you're just Project Fear. Well, I'm afraid I deal in, and always have throughout my career, in the logic of reality rather than romantic fantasies. And this is what the Remainers have got to get over, and the Leavers have got to be able to explain to people how their fantasies, in my view, will actually work. And this is where we start getting into some nitty-gritty stuff, and the role of the city here is extremely important. So, I'm going to ignore things like £350 million a week, which is well known to be not the case. I'm sure you've all read about that. So let's think about the trade deal, because the UK is about trade, always has been. What trade deal will we get? And this goes back to the beginning of the whole process. I imagine you've all heard by now about Article 50 of the treaty is the mechanism for the UK or any state to leave. And the idea is that you give notice to the Council of Ministers that you're going to leave, then there's a 2-year period while they negotiate the exit terms. After that, you then negotiate the trade deal once you have left. Now there's a certain crossover, but it's basically the exit terms first, you leave, and then you talk about trade relations afterwards. Now, the central point about the Brexiteers is immigration. They don't like free movement of people, actually free movement of workers, more precise. That is a central part of their campaign. And if they continue doing that, because that is a fundamental repudiation of a core part of what the EU is about, that is going to be very difficult to sell to the rest of Europe that we should just get away with breaching that. The Boris Gove immigration plan of yesterday or the day before just makes this crystal clear. This is the absolute antithesis of free movement of people. Therefore, the chances of the UK getting a good trade deal are going down sharply. I listened to Commissioner Hill the other day, our commissioner here in London, talking at the London School of Economics, saying the other point is if you compare the people you're about to be negotiating, to call them corrupt, incompetent, stupid, and then refer to their role in the past war, etc., that is not going to endear you to them when you're sitting at the negotiating table. Now, hopefully they will rise above that when the time comes, but the psychology here is very adversarial. Now, what does that mean in practice? 2 years to negotiate how to sack Commissioner Hill and all that sort of thing. This could turn out to be quite a short period. If it's to be extended, this is by unanimity of the other 27. I believe strongly there will not be a unanimity to extend it. If we are sending home Romanians, Poles, Estonians, Latvians, etc., etc., the lower skilled people who will certainly not, 90% of them, will not qualify under our existing point system for non-EU people. If we're sending them home or refusing them admission, they will complain to their home government. Their home government will support them, and when we ask for an extension, at least one, it could be Cyprus, could be Malta, could be Romania, at least one will say no, we will not get an extension. And also keep in mind, whatever trade deal afterwards is done is by unanimity. So if they don't like it, what's going on, it won't happen. So, the unanimity thing, we are going the wrong way to butter up our friends to get their agreement to something nice. So, there is a debate as to exactly when we serve the notice, the Article 15 notice. But let's not worry about that. Let's assume it is served at some suitable stage. The 2-year period starts running. Now, my friends in the Eurosystem are very clear that the ECB, knowing that after 2 years the UK is going to leave, 2 years, or is it longer, but I'm saying 2 years, there's no doubt when the 2-year period finishes, the UK has left. That night, bang, we're out. So the regulatory framework for the financial services industry and financial stability will be in some doubt. I'll come back to that. As far as the ECB is concerned, what will they do? Well, we know what they'll do. Look at the deal that Cameron got in February about all the stuff that they promised not to do. If we leave, turn that round, and you have a list of things that they will do. And the first thing they will do is say all euro-denominated clearing and settlement, and all that goes with it, with cash and derivatives, bring that to the euro area. And we successfully argued, I say we, the UK government, successfully argued before the European Court of Justice that the ECB had overreached its powers in the last time they tried to do that. But in the event of a vote for Brexit, and Boris Gove, if I may amalgamate them, seem to be arguing that we should enact a UK law which immediately disapplies the ECJ. How you do that, I don't know, but that's what they want to do. It would be a pretty odd thing then to turn around to your first act and to go to the European Court of Justice and ask for protection against the ECB. That's just not politically possible. So, the ECB will say immediately, right, all this has got to happen within that 2-year period, and you sitting here, or your technical people, will begin to make the preparations. Now, the other point that Lord Hill made, and I'm going to focus very strongly on the city here, and I'll explain why in a moment. Lord Hill made the case that you have a passport to do your, whatever business you're licensed to do here, you can do across the EU. Great, that's why we're all here. You will not get that in the future. You won't get that. The passport is part of the single market. We're going to leave the single market. We might ask for a Norway deal. Norway is part of the European Economic Area, and they get an amount of this passporting. I'm not quite sure how much, but the one point is Norway pays in and takes all the rules without any say whatsoever in their application. You cannot have the people vote leave, take control, and then say, but actually we're not going to take control of all the financial services regulations and other bits. Politically, that's not possible. It's just a betrayal of what you've just been advocating. So the Norway deal is out, no question. And in fact, to be fair to them, the Leavers have now begun to realise that all this stuff about EA and Canada-style deals, Boris was in favour of a Canada trade deal until, as Lord Mayor, or Mayor of London I should say, somebody told him that actually the Canada deal doesn't include financial services. Oh, I don't want that then. In just a fortnight, change of mind. In fact, all of these trade deals do not include financial services. They now recognise, and I've heard Nigel Lawson, I sat on a panel with him, saying, we don't want all this stuff, we'll have the World Trade Organization rules. WTO rules do not include financial services. We are out in the cold, or will be out in the cold. Does that matter? Well, of course it does, hugely. On the back of your programme here, there are two companies sponsors of this body, UBS. They're a Swiss bank. Why are they here in London for all their investment banking activities? Because the Swiss deal does not include financial services. They need to have a branch in the EU. It's here in London. We leave, by the date of legal Brexit, UBS will have gone somewhere else. Not to Switzerland, somewhere else in the EU. BBVA will do the same. The obvious thing for any European bank is to go home. And the reason is very simple. The moment we leave, on that midnight of Brexit, regulations, and everyone here I assume is familiar with the difference between an EU directive and an EU regulation. The directive is put into UK law. So Capital Requirements Directive, MiFID, is in UK law, one way or another. But the regulation, the R, which goes with it, MiFIR, CRR, that takes direct effect from Europe. The moment we leave, of course, we're not part of Europe, therefore it's not effective. So a major chunk of the real detail of financial regulation in the UK vanishes at midnight on that night. And I have raised this question with a number of, shall I say, officials who've said they can't speak about it on pain of death. In other words, they've been told very clearly this is a problem. And if you read carefully the Treasury's immediate report, they've done two, the long-term and the immediate, you will see the echoes there which they have glossed over. They know full well what the problems are, but they have not chosen to elaborate them on because people might get frightened. But they are very clear, and the answer is, when this has all happened and we have left, the UK regulatory framework will have a large hole in it. And so for the purposes of an EU bank trading with a bank here, they will look at us as an unregulated financial entity. And so in EMIR and CRR, there are additional capital requirements. Because we're unregulated under those circumstances, there's no chance of getting a ruling of equivalence. And again, to quote Commissioner Hill, he's just got, after 4 years of negotiation, an equivalence deal with the United States on CCPs, very narrow thing. Both parties wanted to do it, friendly parties wanted to do it as quickly as possible, and it took them 4 years to come together on the legal niceties to make it equivalent. So that's just one bit. We talk about the whole spectrum of the financial service industry. How many decades will it be? So we will not be equivalent. The first thing being, we won't have a legal framework. Is it possible that the UK Parliament will immediately turn around and say, on one of their first acts, take control, is to say we are going to agree to or require our unelected bureaucrats at the Bank of England and FCA, etc., to immediately replicate Europe's rules and agree slavishly to follow them all whenever they change. Is that taking control? No, it isn't. So that's not going to happen either. So we will not be equivalent. And if you're not equivalent, put it another way around, if you are equivalent, then you have the right to set up a subsidiary in the EU, fully capitalized, fully operational, etc. Why would BBVA, one of the sponsors, why would they set up a subsidiary in Spain, fully capitalized, etc., when that's where they live. The obvious thing to do is go home, and so for Deutsche, BNP, etc. So a significant chunk of the city, first of all that deals in euros, the ECB will say over here and enforce it, and they have the power, obviously. And then all the other banks here, the EU banks, they'll go. This is now a big shift, very quickly, to be completed by midnight of Brexit Day, 2 years out. If we serve the Article 50 notice at the end of this month, in 2 years' time, June the 30th, 2018, for sure, and probably earlier, I would argue, but for sure, in 2 years, we have left, and that's the situation. Now, you are collectively part of the vigilantes of the bond and currency markets. And looking at you, look really what I think of as vigilantes, but maybe you have a fiercer side to you. I think you will when it comes to it. The city's earnings, I have mentioned. You're all aware of the foreign exchange side. The UK's current account deficit is extraordinary. Most Conservative MPs don't even know we have a deficit, let alone how big it is. But the ONS regularly, each year, apart from monthly figures, each year they publish that this is the largest deficit as a percent of GDP since 1948. And now it's, last year, it was 5.2% of GDP, 4.8 the year before. Each year, we're just falling off a cliff. That's £96 billion has to be attracted every year into the UK by the kindness of strangers, quote Governor Carney. Why are you going to continue doing that? And actually, you're going to have to do a lot more, because the 96 billion is struck after the city's earnings, foreign exchange earnings of 70-ish billion. So if a significant chunk of the city moves abroad, moves to the mainland, and that 70-odd billion is lost, 20 of it, by the way, is just straightforward earnings from Europe. So that's obviously 20, that's going to go straight away. So what of the rest? Half of it? I don't know, pluck a number out of the air. But you're suddenly talking about another 50 billion odd on the current account deficit, 150 billion. These are huge numbers. This is quite outside anything which that's getting on for 8% of GDP. This is quite outside the range of any industrialized countries. Even what we have at the moment is 4 times any other deficit in the EU, apart from Cyprus. And I'm not holding out Cyprus as a financial parallel. So that's on the current account. The numbers move towards the numbers which I remember looking at Greece and Portugal in years gone by, and looking at these numbers of the current account deficit saying, this can't work, this can't go on, it'll all blow up, and then, well, I've got other things to do, I'll think about something else. Now I look at these very same numbers in the UK, moving in that direction, and I say, I'm going to speak out about this now, because this is potentially appalling. But then I talked about the current account, so that's external payments. Now what about the internal side? We can debate how much the UK economy will decline as the first shock exit, etc. We can discuss that, and lots of people have different views. But the bottom line of it is that the Treasury's WTO, which is the worst case, the Treasury's forecast on that, immediate forecast, is that the budget deficit will be 30-odd billion higher in 2 years' time than it would otherwise have been. It would have gone down by 30-odd billion, so it's actually going to stay the same at 70-ish billion. Now, the city has just, a chunk of it has moved off, and I say the city, if I were talking in Edinburgh, I would be far more, about the British financial services industry. Well, the Scots have a very strong influence on this, and it's not just the city, it's widely spread around the UK. So, we collectively contribute something over 60 billion to UK government tax revenues. So, a chunk of that moves off, how much, we can debate. So the 70 billion pound budget deficit at the moment, which is meant to be going to disappear in a few years' time, instead of disappearing, it goes from 70 to 100. Now, as the bond market vigilantes, you are going to be sitting there after Article 50 has been served and say, I see this very clearly. This is not an econometric analysis where you can debate this, that and the other. This is the regulations affecting the city will disappear. They will change. The ECB will take it back home. So you know these tax revenues and foreign exchange revenues are going to go. You can just see what's going to happen to the budget deficit and the current account deficit. Are you going to sit back and wait for that? No, you're not. In my view, you may contradict me. I remember, there is a sort of, just to finish on this, a sort of an eerie reminiscence of Black Wednesday. I remember the time very, very vividly. I was there on the trading floor of Salomon Brothers when it all happened. And it was seared into your mind. There was this feeling that this economic policy mix can't work. There's something wrong here. It doesn't all add up. And then suddenly it began to crystallize that it won't work. And sitting there on the trading floor, you saw the main financial institutions of the UK ringing up saying, I'd like to have a little bit more of my portfolio abroad, please. Now, the financial institutions of the UK, when I last looked, have total portfolios of about £3 trillion, about twice GDP. Start talking about 5%, is a portfolio shift to 5% a big shift? That's 150 billion odd pounds. If that starts to try and leave sterling, leave gilts, etc., huge hit, huge hit. And that's before others want to go short, that's before the capital inflows, half of which come from the EU direct investment to finance the factories, which are now going to be subject to tariff barriers. That starts to dry up. You've got on all sides of the equation, it just stops. And you know that. You'll be sitting there looking at these numbers and say, this isn't going to work. And the question is, when are you going to say, are you going to wait till the midnight of Brexit and say, oh gosh, look what's happened? Of course not. Your job is to anticipate, to look ahead and anticipate. And you will. And so last night I was sitting on a panel with a couple of former diplomats who were very eloquently talking about the shape of Article 50 negotiations, etc. And I tried to make them understand that you are not going to allow that to happen. You will, as the vigilantes, you will hit the foreign exchange and the gilt market, etc. And just think what happens if gilt yields go up big time. Remember Black Wednesday, when the current account deficit and the government debt level was a third. In other words, now it is 3 times higher on both counts than it was on Black Wednesday. 3 times higher. And interest rates went up to 15% during the day, and then they fell to 5 2 years later. They're not going to fall by 10% from here. They can't, don't think. So, actually, it's the other way around. They'll go up. And how much do they go up before the UK housing industry is destroyed, and with it the collateral? And what about government finances? Say gilt yields move to 5%, which is a pretty normal sort of rate in the old days. By then, the accumulated debt will be £100 billion, 100% of GDP. Feed that sort of interest charge into the government debt over a few years' time. It becomes just unsustainable. So these are frightening possibilities. This is the reality. This is the hard logic of reality. And is it Project Fear? I'm sorry, the reality is very frightening indeed. And this is not econometric stuff, this is the regulations which will apply to you. And you will do something about it as businesses. You will also do something about it as the vigilantes. And I'm not quite sure when and what it will be which will trigger this, but something will. And from my experience of watching financial markets for the last 40 odd years, when these crises come, they come with a speed and ferocity which everyone is completely shocked by. And for sure, none of the current generation of officials have lived through anything like this. They will find out how it arrives. So, the outlook for Europe is okay, but the big risk is what I just outlined. A major country, 20% of the EU, taking a big hit and subject to a devaluation which is, whatever number you like to choose. There's no floor with sterling. That is a big risk to the rest of the EU, and they know it. So on that, I think I will stop. I hope I've given you some food for thought. Thank you.
Thank you, Graham. We'll go to Christian. it works. So, yeah, first of all, thank you for having the great opportunity to be invited by Global Independence Center and talking to you today about our most fresh product. This is the OECD Economic Outlook, which has just released on Wednesday. So this is the first out of Paris delivery of some thoughts about our OECD Economic Outlook. You know, the OECD, the Economist always writes, I think very unjustified, that the OECD, a rich man's club based in Paris. I guess this is no longer true. I think the OECD has to enlarge, it will enlarge. If it's not doing, in 10 years from now, it will probably not be the rich man's club based in Europe anymore. And we talk about some of these things, and Brexit is only one issue of that. So we really have to rethink that. So this is very fresh, but nevertheless, of course, the 34 member countries and some other candidate countries and incoming countries, of course, there is a big bunch of Europe in that, plus the main advanced economies and some emergings, more to come. So I'm very honored to be here. I am director of the Policy Studies branch, which is in principle the bird's flight above all things. So I'm responsible for all structural policies, for all macroeconomic policies of OECD countries, including public finance, G20, finance, monetary, whatever. So please be aware that nevertheless I have a team of around, say, close to 100 people, and nevertheless cannot solve everything in the tiniest detail. So this is the bird flyer's curse, but of course we will try. And I need a disclaimer. I have to say that of course this must not be the view of my Secretary General, Mr. Angel Gurria, and others. This is based, of course, it's our outlook, but of course it's also my opinion I will try to deliver to you. So I have to bring two greetings to you. First, I have to bring the greetings from Catherine Mann, who is the chief economist and who, of course, did the Outlook launch on Wednesday morning. I know she has joined this club several times, and she very much likes it, and I bring wishes to those who know her. The other greetings I bring is from my colleague who is chairing the Finance and Corporate Directorate. This is Adrian Blundell-Wicknell. So because this was originally called Financial Outlook, but the Financial Outlook will be presented, will be launched next week on Wednesday. So Adrian asked me to be not too bold on finance, so you will not find too much here, but of course we can discuss. So this is what I want to say just up front, and now off it goes. So let me start with the global GDP growth. Our outlook is not, it's neither bad nor good. I think it's just the baseline is just somewhere, and the baseline is mediocre. And if you look at the development starting in 2011 until today, and I think this is really a very disturbing picture, not going into too many details here, that you really see there's no improvement. It's mediocre, it's around 2-3%, so that's not really great, and that's not really great for all the challenges the world economy is facing. I cannot run through all of this, but of course we would need much higher world GDP growth if we have to tackle a lot of problems without disturbances, also for GDP growth, for the inclusiveness of sharing the GDP. So there is a lot at stake. Let me just remind you about some environmental issues, migration, refugee issues, and also tackling some political disturbances, which again have something to do with the development of the world economy as a whole. So it's simply not enough, and we are very disappointed with this baseline. And as you know, if we look on the long run, GDP world growth has been around 4-4.5%, and this is simply broken. So what do we have? And of course, this is also entirely important for the development of the European Union.
there is an issue about trade. It is a trade puzzle. Professor Bishop talked a bit about trade, particularly linked to Brexit. But there is really a trade problem, and we are not really knowing everything about that. But maybe this distinguished audience has also something to share. You can clearly see if you compare the average pre-crisis decade, compare it then with the average 11-14, compare it then with the average 15 to 17, you see it's really not good looking. The normally trade was even growing on a faster pace than GDP growth, and now it's much below that or just in line with that. Of course, I'm looking to China in a minute. For the euro area, the last part from 15 to 17 has a bit recovered, but if you look at the overall figures, that's really quite disappointing. We know, of course, that this is connected to the rebalancing and onshoring in China. Onshoring means that China participates more in global value chains now than it was some years ago because of the improvement. This is part of the good rebalancing, and if you look at the composition of growth, you see this is going principally in the right direction, but nevertheless this road is very bumpy. China is always tempted to seek some short-term macroeconomic support when there are problems coming up, which also lead to problems in the exchange rate, which then lead to problems in the finance, and of course it has also consequences for the very high indebtedness. So, and you clearly see that the share of China's processing trade is declining. Again, part of it is probably very positive to be seen in line with rebalancing, but the bumpiness of this road will go on, and say for China will be a major source of uncertainty and volatility in the world economy, and I do not need to tell you that what's happening in China is more and more important. And this brings me again to something to the European debate. I'm always very sorry that I think there's a lot about economics in the European debate, also in the Brexit debate, but I think we have to look more on this global sphere, and not about just economics on a global sphere, but also on the political settings in the global sphere. I'll probably come back to that. Looking quickly to the US, here we also see some issues, and I think as this was our first distinguished speaker saying, I really don't know, there's an upside thing, there's a downside thing. This is exactly also our view. I think we still see here a mix of contributions to quarterly US GDP growth, which has changed quite a bit. Of course, investment is an issue. Investment is weighing on the US economy still. On the other hand, this is also some rebalancing, of course. We don't know. Maybe it's rebalancing, maybe it's a kind of a peak cycle, which is linked, of course, to the low energy prices and investment in energy sector. So, looking a bit at the unemployment rate, which is also quite disappointing still. So the unemployment rate, if you compare the little black triangles from 2006 with the green things, then you clearly see that the unemployment rate has risen. There is one nice exception if I shift from my OECD hat to my former German hat. So Germany has been quite lucky. There are a lot of reasons. I don't know whether all of that is best practice, but we can never talk. And here you clearly see, if you look on the right side panel, about the employment rate. So there is an issue, again, more for the European side. Here, Japan, but Japan has other problems, and the United States also recovering. So, but it's still a problem. Unemployment is still high, and therefore we would need higher growth also coming closer with that. Which brings me to the risks. So, important here, again, I mentioned it, I think a lot of emerging economies are very vulnerable to exchange rate shocks and high domestic debt. And if you look here on the left-hand panel, how are the external liabilities look like, and of course, and then also looking at the red
part, which is the denomination in foreign currency. You see there are also quite some countries very much affected. And we also look for all of these countries and credit corporations. It has increased in China, so there is an issue of indebtedness. And if my colleague Adrian Blando-Wicknow would be there, he has a big story about the over-indebtedness in emerging markets, and especially in China. And of course, if you look at the recent macroeconomic programs in China, you will see that this feeds, of course, more into old sectors like steel and others, because there is a quick response of construction, and this would also feed the indebtedness of corporations, and then I think some state-owned enterprises, of course, being better off. But there is a huge problem with others who have been financed via the shadow banking sector, and I do not want to go into detail too much. So, and then we really see financial markets still be very volatile. That's an entire risk. On the left-hand panel, recovery, you really see on the equity markets really only in the US compared to summer 15. All others are quite subdued, and I think on the right-hand panel, the volatility chart, which is very familiar to you, I guess. So now this is my Brexit slide, and I will not talk more about Brexit. You see the OECD has taken part, and Secretary General Gurria was here at the London School of Economics, I guess 3 weeks ago, or something like that, to give his view of that. This is our weighted approach. I leave it here with the economics. I think you have already heard about that. I think given the global development, the globalization, also the shifting of the major poles from the advanced economies to the now so-called emerging parts of the world, which is Asia at the forefront right now, I simply believe it would be good, it would be very, very good if the European Union would still include the UK's voice in this concert. And I think we have a bit, and this is what worries me, we have a bit the situation due to the crisis and then fed by the migration and refugee problem that too many people believe just close our shop, we can better do alone. And I entirely think this would be a mistake of a generation that I mentioned, to be very honest. It's not true. I think we need a common voice if we want to govern the world economy, which will get on all aspects more urgent, whether it's on natural resources, energy, finance, then to have a disseparation and dissolution of those regional political forces, I really, to be honest, I find it devastating. And of course the UK should also be aware that this will feed, say, populist discussions in a lot of other countries, and so I press all my thumbs in my hand that the Remain campaign will win that. We really need that. I cannot say we can't live without, but it would be much better and it would save us a lot of years of coordination efforts. So let me talk a little piece about productivity. It was already mentioned here, the issue of labor productivity, TFP. Here, looking at the labor productivity growth, and you can also see even before the crisis, we had a kind of a decline, except US here, which was mentioned. The first speaker from in the US from 2000-2007, this is the exception, and a bit in China, but this normally you see a kind of a secular decline of productivity, and of course this is worrying. And again, the OECD being a bit still dominated by advanced aging economies, I think where should it come from? It can only come, or mainly should come from, if these countries want to keep and to increase their living standards for the future, it has to come out of productivity. And so I think productivity is the core thing. It's even more important than competitiveness, even if these two items are connected. Productivity is key for what is happening in a lot of these advanced aging economies. And if you then look at something which is our current research, and we just found it, maybe that's interesting for some of you, so-called Global Forum of Productivity, where also the UK is a member. So UK will not lose all the ties here, at least not to the OECD, very good UK friends there. So, but if you look at the labor productivity, if you look at what's happening at the frontier of the productivity development. If we look at the top 100 frontier firms, or if we look at the top 5 frontier firms, you clearly see the productivity trend, of course, is a bit changed from the start of the crisis, within the crisis then, but not getting the same steepness again after the crisis. But again, it's on a good way. So the frontier firms are still very productive. Another issue is the non-frontier firms. And here you clearly see something which is confirmed not only by OECD research. There's a kind of a diffusion problem. And so technology does not move, or what is connected, the total factor productivity, to when it breaks down, it trickles down in all corporate processes, does not trickle down anymore that quickly to a non-frontier firm. And this, for sure, is one issue we identify, and of course we try to seek policies to solve the problem. This is also linked to incomes, of course. So if, say, the rule says that wage developments roughly in line with productivity development, you can also clearly see that wages growing much less than productivity in a lot of countries. Again, sometimes the difference is very big. You can say this has something to do for some countries regaining competitiveness. This is true, but this is only a temporary issue for some, and I think the link you can clearly see here is worrying a bit too. So the slow growth on productivity linked to rising inequality in income is also a very worrying issue. And if you look at the right-hand panel, that you can clearly see what's happening here in the red line. It's the top 10. Then to the bottom 10, and then there is the mean income. And this is not here in that, but in the next graph it's a bit complicated, but we'll show it here. If we look at the median income, you will also see there is a de-link of the mean income from the median income, which clearly also shows that the lower part has less, which is also not a good idea. This is what you here see on that slide. You can see that greater productivity dispersion is also linked to higher wage inequality, which is worrying for a lot of countries. So I'm coming to my last part of that. So, if we are not getting out of that, there are a lot of issues which must concern politicians. So here you have a figure for the OECD and a lot of European countries about inactive and unemployed youth, and you can see this is for the OECD average. This is close to 15%, but it's going higher in a lot of countries. And again, this is very worrying also for policymakers, because this lost generation will feed again into the productivity problem. And also it will feed into political tensions, political unrest in some of those countries in the longer term. And if you look on the right-hand panel, what is the employment rate looking like? You see the total is very meager, a bit on the plus, but you clearly see, and this is worrying, the youth is coming down, prime age men is coming down, prime age women coming up a bit. This is maybe due to that more and more everybody, so women step in. This is good from a gender thing, and I agree that bringing more women, especially in Japan, bringing more women in the workforce is very favorable, but another issue is whether this is really a preference-based thing or whether it's an issue about families getting poor and need more income. And then on the old age, again, this could be very positive. You see that the employment rate of the old goes up, and if this is due to the preferences and to better systems, also the remuneration pension system, then it's of course well taken. So it is also an issue, if you look now, of course, and this is an issue of the older. So if there's a cohort which would have been retired with the same amount of money putting into their individual pension systems, and we could put the index here 100 for 2000. If this same cohort would come in 14, it would only be 60% of that, and this is of course also very worrying. So that is also an expropriation, of course, of a lot of pension funds, pension payments, also in pay-as-you-go systems. So now, monetary policy, I've been brief on that, but we are also a bit worried about monetary policy. So there is the issue of negative interest rates, and if you look, central bank asset sheets still high and growing, and the ECB has clearly stated its view that it want to come back to the little blue peak we here had in 2012 at the least. So we will see. Of course, the OECD was very favorable in monetary support, and we urge also lagging parts of the world, which is the European Union and the Eurozone with the central bank, to do more. And finally they did. And of course this could be kept where possible. But of course we are also aware that it poses more and more risks. And if we look at some central banks, there are dominant holders of government bonds. And there was a nice little discussion on Japan by Bloomberg yesterday or the day before yesterday, where they say, come on, the Japanese over-indebtedness is solved. This is monetized. So Bank of Japan will never ask the Japanese government to pay it back. So what's the problem? So what do we, has the Bank of Japan found finally an interesting issue, the perpetuum mobile, or there is a free lunch to talk as an economist. I think this discussion will go on, and I also had a nice discussion at the OECD with Lord Turners, you know, the famous idea of helicopter money, so to speed the economy without having the debt problem anymore, and of course he has some examples. It's a very thing you might think of, but I am still wondering and I'm skeptical, but it's not for today. I just think this is an intellectually very interesting discussion, that we are back with something which my generation of economists would see as the most devilish approach you may have, and now it's coming back to the front offices. So there is an issue for fiscal. Interest rates on sovereign debt are very low. So I speed up a bit. And therefore, of course, we encourage those countries who have the possibility to use their fiscal space. This goes especially also to my home country, which is Germany, which still they have fiscal space. Interest rates are low. There is a refreshment of the infrastructure, very, very necessary. There is an issue of investing in new infrastructure due to the digitalized and global economy developing, energy nets, renewable energies. But of course, the blue thing here on the left side, this is not, again, another perpetuum mobile. I have seen so many bad investment from public entities over the last 20 years. It's really has to be done with scrutiny, and it should be really high quality public investment. If then this could be done, as with the Juncker plan in the European Union, in a kind of a collective action, also leading to some even more harmonization of some regulations within Europe with hamper, say, cross-border public investments, this would be very, very great. And I think this is my last slide. Structural policies, where this is one of the OECD main assets we did for the G20, all 1,100 measures of national growth plans. So there is no one country everything is single, and there's always a case. But we have some unique packages here. What you can do, shift the composition to public spending, encourage firm entry and investment. So this is some of those things, and I think the presentation is public. Just go through. Last but not least, in the euro area, we still have the issue of non-performing loans, especially in Italy. They wasted some years because they tried to wait for maybe better conditions, and now they really have to tackle their non-performing loans. I was in Italy last week and talked to people, and I'm hopeful they are now coming along with that. So to sum up, subdued investment, trade, employment, wage, productivity, there are risks. There are broken promises which feed into the political things. There are, we hope, good recommendations from the OECD. And we hope that we need really to lift the low growth equilibrium to a higher growth equilibrium. So, and I thank you very much for your attention. Thank you, Christian. So we'll open the floor for some questions. I'll try to get us started. First, a question for Mr. Bishop. If Brexit were to occur, is there any possibility that it could be undone? Is there a re-enter that could happen, or is that out of the question?
Well, let's start with the basis of that we have actually left. And then could we decide this was all terribly bad, terribly silly idea, we want to reapply? Of course we can. And Article 50, the last indent of it says, yes, you can reapply in the normal way. So there's no going back to what we've got now. The starting point would be we'd have to join the euro, we'd have to be in Schengen, boom, 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 boom. All the opt-outs that we have at the moment, there's a quite a long list of them, none of that would be available in the future. So we can reapply afterwards, yes, but not the same deal. Now, the other thing implicit in your question, I think, is having served the Article 50 notice, could we unserve it? There's nothing in the text which says you can or you can't. The question is, if we decided to withdraw it, would the other governments agree to that? They might well do. Is it likely? It's only the only way that's going to happen, in my view, is if the vigilantes have done their work and the population has discovered actually this wasn't a very good idea, and the government picks that up and whatever government it is. At that stage, yes, we would be relying on the kindness of strangers in the rest of Europe. It could happen, but pretty unlikely.
Thank you. And then a question for Mr. Castro. If we were to do something along the lines of helicopter money, would you expect it to be coordinated? In other words, would it have to happen in all countries at the same time to have the right effect, or do you think it could be a more piecemeal experiment where it's run in Japan first and then spreads to other places?
I think this is the issue. I think all cases are very, very different. So I do not see this as a collective business, but it can spread. And I fear again, we all probably agree that you can do this in some cases. It has been done in some cases, but it has an extreme risk of political moral hazard. And of course, it may start under conditions and situations where this might help indeed to get rid of the debt spiral, nevertheless trying to feed the economy with the necessary impulse, monetary impulse. But it would, I'm quite sure, it would spread to countries, say Brazil. I don't know whether there's somebody from Brazil, I think, where it would be a disaster. And then this would add to the problem I already tried to point you. This is say that our monetary ammunition is getting wet. And this is not a good idea for a next crisis to come. And this is why I forgot this bit to say, why it's relatively important, I think, that central bankers need to show if there is substantial degree of normalization, also not to be too cautious with the policy rates, to be honest. To show the markets it's on a better trend. And if the market line is so subdued from the expectations of the FOMC members, this is maybe they don't believe too much in that something is moving over the next years. And this I would also find very worrying, especially if monetary policy will feed this expectation too long.
Let's open up the floor to questions. Question in the back?
Yes, it's more of an observation, in fact. Obviously, Brexit is the most dangerous thing. I think you pointed it out very well, Graham, the possibilities for this audience. But I think that you're a little wrong in just assuming it's to do with people relatively uneducated and fear of immigration. For since I'm a researcher, a statistician, and I've got an opinion poll myself going on about Brexit amongst business people. And I'm absolutely astonished that currently it is running against, i.e. in favour of leaving. And I'm asking why they give this decision. And it's absolutely emotional, it's all to do with independence, it's all to do with abstract, well, not abstract, it's visceral matters. In fact, immigration is barely mentioned. And you can't, Project Fear won't change their mind. You've got to attack them emotionally, in my view. And the emotional attack is that inevitably it will lead to a super state, the other side of the channel, which you'll have no part of,
and which for hundreds of years we fought against the dominance of anybody on the other side of the channel. And that is the thing which may get them to think a little bit differently. But at the moment, I think they're going to head off into independence, and that's what they need, etc., etc. And this is people educated.
Yeah.
Sorry to say.
Yeah, I don't disagree with that. It's just my experience in the street. The people who are vehemently, almost violently against come from a particular stratum of society. But I do meet lots of people, my friends and my social friends, who are dead against it. And it is this romantic notion of let's stand free, etc. This is a different world. This is not the Victorian Empire. That's all gone. And this is why these people, the problem with Project Fear, and I refuse to use it, I'm just saying this is the reality, and it's frightening. If anyone wants to contradict my analysis of the financial system and what it means to the city, which is so important in such an unbalanced situation, I'd be pleased to hear the analysis. But to paint the opposite, it's easy, or it was easy in the 1950s and 60s to say Europe is all about peace. And that was when everyone, I remember very vividly, I was at Salomon Brothers, a young chap that came and saw me one morning after, he still obviously had been for a good dinner the night before, and he talked to Willie Whitelaw. Now, many of you, Willie Whitelaw, is that? Right. Okay, former Deputy Prime Minister to Mrs. Thatcher. And my young colleague had a dinner with him and said, oh, I'm against Europe, etc. And Willie Whitelaw said to him, when you have been commanding a tank regiment and your friend in the tank in front of you just exploded, you know you don't want that to happen again. And my young friend knew exactly what he meant. He was converted. But Willie Whitelaw has been dead for many years. My elderly mother in the RAF, etc., has just gone. That generation has disappeared. And the idea of war in Europe now seems completely fanciful. To my children, inconceivable. But that was the driving force. That was the higher ideal, the vision, that drove it. And now to say, I'm violently in favour of the status quo, we must have the single market, people here know what that means. I can tell you the people in the street have no real concept of it. And it doesn't ring like an emotional bell at all. I don't know what to say. We may, and actually let me ask a show of hands. Of the people who registered to vote here, that's probably not very many of you actually, but of the people who registered to vote, who is going to vote to leave? Who's going to vote to remain? Well that's encouraging. But you're the only one. Damn it. Anyway, but that's interesting, and I'm not surprised. And the city, the numbers I've laid out, people may not have thought about them, but they're well known, the regulatory arguments, etc. This is an intellectual argument. This is also an argument for your personal pocket. This will be best served by staying in. But the freedom, independence is an obvious one. But remember, Britain's foreign policy for 400 or 500 years has always been make sure we are in a smallish country, medium-sized country, make sure they across there do not gang up on us. And what are we doing now? They are coming together for very good and honourable reasons, and we are about to go away and leave them to be a gang. This is extraordinary. This is 500 years of foreign policy in reverse. Anyway, but I recognise it's not just people down here.
Question in the middle?
Not a Brexit question, I'm afraid. I think we saw the ghost of Brexit appear when Gordon Brown was campaigning. He famously forgot to turn off his microphone when speaking to one of his constituents. Gordon Brown was campaigning and speaking to one of his constituents, forgot to turn off his microphone.
Yeah.
When she approached him and was complaining about the number of Polish immigrants. And I was simply, my question is, I was wondering, even after the Brexit vote is over and we put this all behind us, what do you think the government can do to sort of allay some of these fears? Because I personally think that Brexit is sort of a bit of bad luck. bad timing. Meaning, I agree with you that the political argument is gone and war in Europe is no longer conceivable, which is why it's turned into an economic argument. And you're the gentleman in the back. I know people in the city who will vote to leave even though it's against their economic interests, all the way down to my porter in my building who will also vote to leave because he's afraid of European immigrants coming and taking his job. So the question is, once this is behind us, these concerns will still be here because I think the economic pie has sort of shrunk following the economic crisis, and people seem more concerned about this issue than they were, say, in 2004, 5, and 6, when there was plenty to go around and it didn't matter if immigrants were here, and the whole argument of labor coming into Britain and lowering labor costs and making things better for us was an argument that people accepted. Now, because the economic pie is smaller, I think people are afraid of their jobs being taken away and so on. So even if we do vote to remain, there'll still be this 50% of the population who will be concerned with this. What do you think the government can do, what policy steps can be taken to sort of bring them back into the fold and show them that Project Europe is still an ideal worth aspiring to?
Well, it's very difficult. The answer is to get an extra couple of points on your chart of growth in Europe. Put another 2% on the top. This will melt away after a few years. The unemployment rate would come down. The migration would be seen as a boom, which it is. And the paradox for the UK is a significant chunk of our relatively good economic growth shown in the charts is not from extra productivity and GDP per capita, but more capitals, more people, the migrants. Without them, our growth would have been mediocre. So get growth. Now, yes, here's the magic one. Growth, let it happen. It's not so easy. But if it doesn't happen, we're going to have a lengthy period where the people who are well, not the higher income people who are benefiting from globalization, but the people at the bottom of the pile who are indeed fearful of their jobs being taken away by technology, and rightly so. They are going to be a problem with us for a long, long time. The Brexit debate, the more I have personally seen it on the streets, the more I understand about Marine Le Pen and Podemos and Beto Grillo, etc., AFD. There is this strand, is it 10%, is it 25% of the population who's been upset by globalization and all that goes with it. And they will continue to be, unless we get twice the level of growth that you're forecasting. Change your forecast.
Question on the side.
Thanks. So first I want to just quickly correct that there is actually an honest-to-God war in Europe today in the Ukraine, partly instigated by the EU's hubris and ineptitude and its overtures to the Ukraine. But in any case, my main question is about Japan and the lessons it has for monetary policy in the UK and fiscal policy in Europe. I think the consensus in the markets is, were there a Brexit, that there would be a devaluation, but that the Bank of England would respond by cutting rates to zero or possibly negative territory. So housing prices might well go up, for example. And second, in terms of fiscal space, I think Japan offers a corrective to the conventional wisdom. There's lots of fiscal space, especially when your central bank is monetizing your debt, as it is in Europe. Unfortunately, the EU signed a not very well thought out fiscal compact a few years ago. Shouldn't the OECD be prompting them to rethink that and to allow a lot more fiscal space?
Okay, so let me come back to that a bit. Of course, the main, I don't know what's the next possible choices in Japan, but I think whatever you can learn from Japan, macroeconomic policies, that it never brought them really out of the slump until today. So when I enter in the discussions 15 years ago, all the arguments you find here about monetary support, so it's an extreme form of whatever it takes. You also have very extreme supportive measures by fiscal policies. However we define fiscal space, if we define fiscal space for Japan, except now this very fresh, why don't they just monetize the debt? And it is already been done. If you look at the figures I showed you, there has nothing much happened. And I think, to be honest, I'm still surprised that this unsustainable, say, debt to GDP ratio has had no influence at all. There are some issues, I know. Japan, of course, has also a huge high foreign assets and some other issues which interplay here. But I think for Japan, I think you cannot really learn that the Japanese macroeconomic policies was very supportive to the problems in Japan. On the other hand, they still miss the necessary structural reforms in Japan. So in Japan, I would more count on structural reforms, and these structural reforms probably, as there are also the third arrow is also not really getting into the bull's eye. Maybe this is also needs institutional reform in Japan. But this is not only true for Japan, to be very honest. Also in Europe, there are some countries which probably need quite a lot of that too. And then, of course, that has to be weighed against the austerity debate. But this was not your question. Coming back to Europe and fiscal. As I already said, I believe there are some countries in Europe which could do more on fiscal and which could do more on structural. And I mentioned one big country, this is especially Germany. France, for instance, maybe has not so much fiscal space, but France, of course, can also really do much more and bolder structural reforms as they do of today. In some other countries, it's very split. So I would say, for Europe, countries should really reflect their fiscal space, and the OECD has done some research which shows, also given the very low interest rate right now, there are more opportunities. But it's not just about spending more, it's also with higher debt. It's also about spending more growth and productive friendly. And I think if we look at the budgets of European countries and see their quality content in respect to sustainable growth, then you see it's not that good looking. So also those countries where have not so much fiscal space can do a lot. Coming to the fiscal rules of the European system, I may out myself that I'm a big part of this rule system. Devoted a lot of my career to develop the Stability and Growth Pact, and also a bit responsible for the fiscal compact in my former life. I think this has to be, of course, if you just think about that this will hamper a necessary macroeconomic response, there is a problem. But again, to have a necessary macroeconomic response, which I very much support, in contrast to a lot of my German colleagues, I'm a very proactive macroeconomic guy. But this has to be reflected, of course, against the political economy in a hybrid federation, where in the end, nevertheless, and this is what is happening right now, some countries have also in the end to pay the mess of some other countries. And therefore, a certain stabilization, so having a good fiscal rule, which of course also allows exemption for extreme cases, and we for sure had extreme cases, this is very, very, very good. And I'm also responsible for some of the flexibility in the Stability and Growth Pact, which came in after the French-German crash with the ECOFIN Council and the Commission in 2002, that of course now there is room, and this is true for instance for Italy, you have leeway from the fiscal rule system if you do really good investment, if you really do deep-rooted structural reforms. And I think this is very, very necessary in the system. So given for the political economy of the European hybrid federation, I think this is a well-balanced system, which does not mean it can't be better. And I would also not recommend the German system or the European system for every other country in the world. There is no one size fits all. This is very, very true. Also from an OECD viewpoint.
Question in the back.
Thanks very much. When you mentioned I suppose my question really is in terms of the trickle down of the economic growth to people who may be at the bottom in terms of how they feel about the Brexit situation. My question really was the lack of investment in education and in feeling more part of Europe that could have taken place, that sense of identity, which that sort of missed opportunity in a way, and obviously it's coming in 3 weeks to a head. And my second part of my question was, in terms of TTIP in people's minds, may that also add on another sense of a reason that some people might feel to vote out, in terms of if they're at the bottom feeling that the trickle-down effect hasn't quite reached them, and whether austerity measures, in a sense, have been a little too harsh in terms of having a good feeling about being in Europe, that if it's starting to bite, then the polarization and the inevitable tendency to fear who's going to take your job becomes more relevant. Cheers.
Well, TTIP, I must say, today I really don't think it's going to happen. I think Obama's time has run out. There's a summit, I think, in a couple of days where this is the final time for Europe to get its act together. I don't think TTIP's going to happen, and therefore, whether it will be formally cancelled by June the 23rd and therefore drop out of being a debate in the UK, that's probably unrealistic. But this trickle-down effect and the talk about reform, the European semester, which I'm sure you were involved in designing, this is a very interesting process. And the Greek crisis of 2009, I suppose, when they suddenly discovered their budget deficit was going to be 12% of GDP rather than 3% in the autumn of the year in question. The shock of that has caused Euro area, but actually Europe as a whole, to have a far more, I hesitate to use the word, integrated view of economic policy, because every country's policies now, we know, spill over to their neighbour. And so there is a greater degree of coordination. And when do you cross the boundary between a very tight coordination? When does that become effective control? This is where the European semester is very interesting. And the annual survey, the annual process which has just finished, about to be finished, when the heads of government finally bless the recommendations from the Commission to each country as to what you saw the list of reforms which should be done. This is country by country in Europe. You should do this, education, infrastructure, whatever it may be. That each country should do something which will help itself. And if it does it, then it will also help everyone. That should make one feel good about being part of Europe, but this is all very abstract. On the streets, and I do this every week and sometimes twice a week now, so it's right at the forefront of my mind. To stand and talk to people about the benefits of the European semester, when there's somebody who's probably not even got any O-levels or GCSEs, and try and explain the real benefits to them, and why they shouldn't just say, I want out, I want to be independent, I want to be free. It doesn't cut the ice. That's the problem. We need to see afterwards, when it has all worked, and growth has picked up, productivity is rising, and growth has picked up, and budget deficits have come down, all the good things that happen. Then we can turn around to the people and say, the sacrifice was worthwhile, look what you've got now. But I'm afraid at the moment, you're making a sacrifice, and you can't see what might happen, and you know what you're against, the sacrifice. Difficult.
Well, we'll have to stop there on this panel. We're going to take a short break. We'll reconvene at 11 o'clock for our third panel. Please join me in thanking our guests.
His was unique to New York. It stopped being in Memphis where you drive it. Moved to New York was outside. You're still getting the Yesterday, I never, I've explained this to Joe. I swear to God, I'm born on that I mean, they could be doing it right there on the desk. I'm clueless. Right? I'm fitting to people, social media. I don't say anything about race, I say solidarity. Doesn't sound
But the point is, the sense it does. But I mean, in my opinion, if we ever do that, it's worth it. So are we going to come back in?
That's a different perhaps. Yeah, we could maybe. No, at that stage I was living in. So actually I just Brian. Yeah, he sent an invitation. 3 times. His wife takes care of it. Yeah, but
We've got text.
Government based in Paris and has come to us today. And then Manuel Balmaceda, the chief economist of CEMEX and a GIC board member. We'll start with Yusuke.
Thank you for the introduction. Thank you for the invitation to speak. Sometimes Japan seems to have fallen off the map, so it's a pleasure to be invited to actually speak about our problems and what it poses for the rest of the world. I mean, I think we had already a few questions about Japan in our previous session. So, there is a lot of problems to talk about. I don't have all the solutions, so maybe I will come up with more questions than answers in the next 20 minutes. I've been told by Julian that not all of you are sort of Japan specialists, so it's a sort of somewhat anticlimactic because the Prime Minister has already announced Wednesday that he is going to defer the consumption tax hike to October 2019, but I will try to sort of walk you through what we have gone through during the past 3 years and what lies ahead. Okay, so this is the title of my presentation is sort of titled Abenomics 2.0, but if you read or listened to the Prime Minister's press conference Wednesday, he has deferred the consumption tax to 2019, which probably means that he wants to serve at least until 2020 and maybe try hand at constitutional reform, which is another one of his platform promises, if not leading to a referendum, like here in the UK. So anyway, this is where we started from. As many of you know, Japan has been mired in a 20-year disinflationary spiral where we've had lots of deficits that have accumulated to lots of debt. And then, of course, our population peaked around 1995, and it's decreasing. By most projections, the population now is 125 million. It may decrease to about 18 million in 50 years' time. So one of our challenges to boost our reproductive rate so that we may have a stable population, hopefully around 100 million. But all of these factors are sort of contributing to sort of a depression in the psychological sense that sort of turns around in a vicious circle. And this is where Abenomics came in to try to jumpstart the economy to reach a sort of what in physics terms the physicists would call a escape velocity that would sort of levitate the economy from this deflationary gravity that had captured the Japanese economy and Japanese citizens' minds for the last 20 years. So if you remember, he called it the three arrows, borrowing tenet from the old Mori samurai family, where this father, the daimyo lord, told his three sons to stick together because three arrows bound together is very hard to break. So Abenomics tried to combine, this was before the OECD actually, maybe Christian has already advocated this already, but we have tried to combine fiscal, monetary, and structural policies to reinvigorate growth. But I have to admit that it has not succeeded yet. Okay, but what we've tried to do was, since Governor Kuroda was elected or appointed in March 2013, he has come up with what he's called a audacious monetary policy, where the Bank of Japan has not only embarked on a quantitative easing that combines the quantitative element, the quantitative easing with the credit easing elements that the Federal Reserve has taken, and then now he has already since January this year, he has gone in, taken back the interest rate perspective to go into negative rates for at least some of the bank deposits that rests with the central bank, and he's called it a sort of a 3D approach because it combines it brings back the interest rate element or axis in addition to the qualitative and the quantitative easing that they have been doing for the last couple of years. And then, in terms of the fiscal policy, we have characterized it as a flexible one. Many people misunderstand the fiscal policy element as being just the fiscal stimulus, but it was always predicated that once the economy reached a sort of a escape velocity, that the consolidation element would kick in, and that's what exactly we did with the consumption tax hike in April of 2014, which in hindsight has been rather adverse, but we'll come back to that later. And then, of course, there was the structural reform element. I have to admit that it has not been forceful as it may have been, might have been, but at least corporate tax rate has been reduced to marginally below 30%. There's more flexibility in the labor market, which also depresses wages. And there's been lots of reform in the corporate governance front. So for fiscal 2014 and 2015, we've actually had record corporate profits that exceeds what the corporate sector achieved during the bubble years 25 years ago. And this has been partly brought back in terms of dividends to shareholders. And then, as Christian explained or displayed in his chart comparing the unemployment rates in the OECD countries, Japan does have the lowest unemployment rate among any economy in the world. So, but there were the known unknowns and the unknown unknowns in terms of the noises to our sort of projections. Of course, everyone knew that the Chinese economy was slowing down, and that because Japanese exporters had relocated many of their factories abroad, that exports would not be coming back in a sort of a V shape like they did in the 80s or the 90s. And then because of this labor market flexibility, which is a sort of a two-sided coin, although labor market is very tight, there is much wage rigidity or restraint among the corporates and even among the labor unions, because they are mindful that Japan needs to be competitive vis-a-vis United States, not only in the United States, Europe, but with our neighbors in Asia, i.e. Korea, China, and even South Asia. So wages have been held very sort of low in spite of the tightness in the labor markets. And then, as everyone knows, no one predicted oil prices to dip below 50, let alone 40, and down to 30. So, but at the same time, there have been pleasant surprises. Just name a couple. Japan has always exported tourists. I mean, in the 80s, if you saw a Oriental with a pair of eyeglasses and maybe a camera, it was always Japanese. It's not anymore. It's probably more China, but we have had our share of Chinese and other tourists in Japan. In Japan, we had more than 20 million tourists last year. Half of them came from the Greater China, but in any case, Japan recorded the first travel balance of payment surplus in 53 years, and they spent 3.5 trillion yen in Japan. But however, that's not counted as consumption in GDP terms, it's counted as exports. But so that's another issue. Well, maybe we'll come back to when I mention the probable measurements that someone else raised in the first session this morning. And then on the corporate governance front, Sharp, large watchmaker, they fell into bankruptcy, but has been picked up by a Taiwanese maker, Foxconn, which you may know that makes Apple iPhones and iPads, which would have been unimagined, well, maybe 10 years ago. And then the chairman of Seven & i, they are the owners of not only 7-Eleven in Japan, but they had bought their parent in the U.S. So anyway, this chairman was ousted with the vote from the vote of outside the directors, which is a very rare or maybe the first such phenomenon in Japan. So corporate governance is also changing. Okay, so in a nutshell, there's been noise, there's been pleasant surprises, but the end result is that the pickup has been very modest, unfortunately. Real growth returned to 2% in 2013, but fell by 0.9%, mostly attributed to the VAT hike, and only recovered to 0.8 in fiscal 2015. And then, I guess the most important or the most serious problem is that inflation continues to disappoint. The CPI for 2015 was only 0.2%, but there's a measurement problem here as well, and maybe a definition problem, because in Japan the BOJ has picked its inflation target in terms of the overall CPI that includes food and energy prices. So if you take out the energy element, it goes up to about 1%. So you can say that the BOJ has achieved modest success, but in any case, they are far from achieving their explicit target of 2%. And there is a monetary policy dilemma, because in spite of all this money that they have printed and dispersed to the economy, the inflation has been very, very much disappointing. And then consumption, held back by this wage restraint, has been very fragile. In fact, it has continued to deteriorate even after the effect of the consumption tax hike in 2014 was supposed to have dissipated. So the biggest debate in Japan up until a week ago has been to raise or not to raise VAT in 2017, as promised by the Prime Minister when he actually deferred the first hike or the second hike 2 years ago. The present Parliament ended just Tuesday or Wednesday, and we are in election mode. The Upper House election has been called for July 10th, and this was already known. So Omnibus 2.0 was actually announced September last year with a view to this Upper House election coming up this summer. So it's not as sexy or as appealing as the Abenomics 1.0, because it's mostly for domestic consumption. You can just consider it as a sort of a platform for the Upper House election coming next month. But what I tried to sort of loosely translate is the government's intention to sort of defy this demographic movements by putting more women, more elderly in work, and through those actions, hopefully achieve a nominal GDP of 600 trillion yen by fiscal 2021. And then, sorry, I forgot to add the sort of the target dates for the next two, but the 1.8 that's expected productivity is due 2025, as well as the Noble Job Leaders due to parent care. So anyway, so the government's growth strategy in this second round is Industry 4.0. That's been a baby pioneered by the Germans, but we are embarking on the same issues, the Internet of Things, artificial intelligence, robotics, intelligent transport systems. Before returning to London last summer, I happened to be posted in Nagoya, the industrial heartland of Japan, and I had the opportunity to visit many factories, many Toyota factories, their suppliers, aerospace. I mean, you name it, Nagoya and its surroundings, they will have a factory of some kind. And what you notice there is that not only at the Toyota factory, but their suppliers, they are highly automated. They use robotics, and Toyota just announced a investment into Google, so they are actually going much further into this than initially thought. And another pillar is healthcare. Japan is an aging society, but we hope to turn that handicap into advantage by in such areas as regenerative medicine. You may remember that in 2012, a pioneer in this area, Professor Yamanaka, he won the Nobel Prize in this area, and this is one of the areas that the government and the industry is targeting as the vanguard in the world. And then I already mentioned about inbound tourism. The government is, the number of tourists almost increased by 50% last year, and we hope to double that, we hope to increase that by another 50% over the next 5 years, meaning more than 30 million tourists, which will hopefully bring in 8 trillion yen worth of, if not consumption, exports to the economy. And then there is another element that has been partly initiated or instigated by the Chinese establishment of the Asian Infrastructure Investment Bank. Japan is advocating what we call a quality infrastructure initiative, where we emphasize life cycle economic efficiency, disaster resilience, technology transfer, among other issues. And this has been incorporated in the Ise-Shima, one of the Ise-Shima declarations. Okay. To the Ise-Shima summit last week. So you will see that the three-pronged approach is sort of mirror image of the three arrows approach that was employed for Maximum 1.0. Of course, each country has its own freedom to pursue its what each country deems necessary or convenient. But the G7 countries agreed to use all tools necessary, monetary, fiscal, and structural, to reinvigorate growth. And then, and I guess the most noteworthy in the monetary policy side is the sort of this explicit mention to use to continue usage of unconventional policies. And I think Christian already mentioned this, but on the fiscal policy side, there is an emphasis on infrastructure investment, utilizing the low interest rates that are available across the industrialized countries' economies. On the structural front, this has already been captured by Christian, but there is an emphasis on meeting the demographic challenge, not only in Japan, but in Europe, if not in the United States. And then from the Japanese point of view, the most important is the agreement on exchange rates, where in the second bullet we emphasize that volatility, disorderly movements are adverse for economic and financial stability. Okay, so back to fiscal policy. In anticipation of the decision to raise the VAT as originally scheduled, the government had already initiated almost 100 trillion worth of fiscal policy in terms of the 2015 supplemental budget and the 2016 budget, which is to be front-loaded in terms of implementation. And then there was unfortunately an earthquake in Kumamoto on April 17, which crippled the local economy. So we had to come up with another supplemental budget, a very small one, but I guess the political aftershock was that the double election that some pundits had been speculating had to be cancelled because to accelerate the relief efforts. So, in a nutshell, the Prime Minister announced just a couple of days ago that the VAT hike will be deferred to October 2019, and that there is another fiscal stimulus package coming that will hopefully buttress the fragile economy, in particular consumption, but we will find a way to maintain our fiscal policy target, namely a primary balance by 2020. Now, I'm going to finish with more questions than answers. So I think someone asked the measurement problem. I mean, I have exactly the same questions myself. I mean, are we actually measuring rightly output and as well as prices in this challenge of shrinking demographics and capital accumulation? I don't have any answer. And of course, I cannot claim that Abenomics is succeeding, but just for sour grapes, we're measuring GDP, but actually Japan is the largest creditor country in Japan. In the world, we have more than 300 trillion yen worth of foreign assets, from which we earn 20 trillion yen per year. That's 4% in terms of GDP. And then, if you look at per capita real growth, we're not so bad. Goodness, so bad. And Paul Krugman, Rajan, now at the Reserve Bank in India, and there have been articles in Foreign Affairs that point to this. So maybe we should not be feeling so bad about this Thursday. And then nobody, if you're a Brexiter, you may not believe the Asian Treasury, but this compares the average growth and output per hour among the G7 countries. You can see that Japan is not doing so bad. And finally, this is a favorite chart that Lord Turner, former working colleague of mine, uses. And, oops, sorry. And you can see, okay. So, I cannot admit this as still a official, but we are reaching or nearing this territory, as Christian said. I'm going to end with a plea for you to visit Japan, look at Japan's problems, and hopefully, we can jointly solve this disinflation problem that is overshadowing the global economy. Thank you very much.
Okay, well, thank you very much again for inviting me here to talk to this this group that I must admit I hadn't heard of before, but apparently is well known. So that's my fault for not having heard about it, of course. But just to introduce myself, I worked at the OECD for a long time, and for the last decade of my career there, I was working as the head of the China desk there. Since retiring a couple of years, 2 years ago, I was approached by the Guangdong provincial government and asked whether I would act as a consultant for them, both giving them an outsider's view of what was happening in China, and also giving them views on what was happening in Europe, and also from time to time India, because as well as working on China, I was also the head of the India desk for that decade. So I'm not speaking in any way for the Chinese government. I'm just a complete outsider as far as they're concerned. And so what I wanted to talk to today was not so much about the short-term indicators, where I think the forecast of the economy is going to be for the next year, but to look more at whether we can, to the extent to which we can believe the Chinese figures, the Chinese GDP growth figures, because I know that's been a big and continuing issue outside of China. And then also to present an alternative estimate of how I think Chinese GDP has been growing, and then also to give some background on how I think the economic policies are likely to develop over the next year, rather than looking at outturns for economic growth. So. The essential point, I think, within China is to realise that it's far from being a monolithic dictatorship. You have very strong different groups within the Chinese Communist Party that take very different views on the reform of the economy, and on the role of the government and the role of state-owned enterprises, for example, in the economy. And the new president, when he came to power, or I prefer actually to call him the General Secretary rather than the president. I mean, I think that reflects much better what the situation is in China. The new General Secretary, within a year, had a party congress that issued a very strong manifesto for reform. But really, in the past couple of years, the extent of reform has been still quite limited, and I think that's partially because there's still a considerable pushback from those parts of the Communist Party that don't see the market as being the key factor driving the economy. And I mean, this, I think, showed up quite well in the behavior of economic policy during the last summer, when you saw the very mixed signals that were given out, both in relation to the stock market and to the exchange rate. So you saw that in terms of the securities market, after a period when reform had been introduced, the government was no longer going to determine which companies could make IPOs on the stock market. Of course, when the market fell, the national team was mobilized and tried to stop the fall. But of course, they were unsuccessful, and eventually the head of the securities regulator was sacked, and another person was brought in to head the security regulator. So you see the two on the one side, you have people who are arguing for the role of the market, and on the other side, you have those who are still disputing the role of the market. And I think this kind of split in opinion in China has also been seen this spring. If we look at the types of responses that have been to the economic data in the first quarter of this year, we see very different stories coming out from people who are working all within 1 or 2 kilometers of each other. The commissioner of the NBS said that he thought there would be a U-shaped recovery to the economy. A person in authority, there was an article though in the People's Daily just recently, authored by a person in authority. That's generally expected to be the economic advisor to the General Secretary. He said that he thought there would be an L-shaped recovery. Of course, I had some difficulty understanding what an L-shaped recovery was. It doesn't sound like a recovery. But anyway, it was going to be an L-shaped recovery. The NDRC spokesman said that there had been a good start to the year, but the Deputy Prime Minister said there was downward pressure, but activity was picking up. And then if you look at the actual data, the NBS's first quarter data on a quarterly basis showed growth of only 4.5%. That's no one can understand that, in fact, so we have to discount that a bit. But so the question is, when we hear that there's going to be a recovery from a recession, where do we see in the official data that there has been a recession? This is the year-on-year growth rate of the Chinese economy from the official data. And if you look, you look at that and I don't see a recession. What I see is just a steady but very slight downturn in the economy, with the growth rate dropping over a 3-year period by a percentage point. Not a tremendous source of worry, really. And yet people are talking of a recession. So why do I think that? Why do I think that? What's the problem here? I think that the stability of growth in China is actually a measurement artifact. I don't think it's the result of any bias or manipulation of the data, but it's the result of using actually an incorrect formula for working out the real growth rate of the Chinese economy. And I think that there's a lot of documentary evidence to show that the NBS has known that this is a major problem for computing GDP growth, but up to now hasn't been able to solve the basic problem. Just here, I've just put an equation up just to show you how generally real GDP can be measured. This is one of there are 2 basic ways. One is on an output measure and one is on an expenditure measure. The way that the Chinese have done it in the past is to look at it on an output basis. And if you do it on an output basis, you have to say you take gross output, you take away the value of inputs, and that gives you your value added. If you rearrange that equation, I'm sorry, this is the formatting has got thrown out between when I sent it and when it's here now. But if you look at you can rearrange the basic formula into 2 parts, the red part and the purple part. And the problem with the way that the Chinese government, the Chinese NBS, calculates the growth of GDP is that they use just the red component. They don't use the purple component. Now, the problem with that then is that if you can see from the formula that if the price of gross output and the price of inputs moves differently, then you'll bias your measure of real growth. And that essentially has been what's happening in China, and it's of course a very big problem for the measurement of GDP when you get very sharp movements in commodity prices, when input prices decline a lot more than output prices. So actually, the NBS is in has a major problem with this because it has no data on intermediate consumption, and it has no data on the price of inputs broken down by industrial sectors. So really, it can't produce a better estimate at the moment of GDP if it wants to show growth of manufacturing, growth of services, growth of agriculture. And that, of course, that approach is really a very approach that's ingrained in the way that communist countries have thought about GDP. They're very focused on output rather than on demand. The alternative way is to look at of measuring GDP. One that's usually used in most countries is to look at expenditure data. And the problem has been in China that the expenditure data has been very poor quality. But the quality appears to have improved markedly with the last release of national accounts. And I think now the NBS produce enough data for an outsider to make a reasonable estimate for what the growth of GDP would be if we measured it on an expenditure basis, the same as is done in most other countries. Of course, an outsider like myself has to apply a lot of arithmetical and algorithmic manipulation of the published data to get the result. But although, of course, the NBS itself has all this information, but doesn't want to publish it. So that, if we remember, that is the figure that we get from the official data, year-on-year growth rate. And then if we measure if we apply use all these fragmentary pieces of information and build them together in one coherent piece of information to get an estimate of GDP from expenditure. That's what the growth figures look like if we measure from the expenditure side, and we see that as I outlined, the fact that commodity prices, import prices have been falling, and also the import intensity has been falling, has meant that the real growth rate in China, looked at from the expenditure side, has been probably a couple of points lower than the official estimate. And in fact, of course, there's a third way of looking at the national accounts, and that's through looking at the value added in nominal terms, the income estimate. And there, of course, which is really what if we go back, the Chinese, by taking value added, that is the income, but they're dividing it by the price of gross output rather than by a GDP deflator. But of course, there's no GDP deflator for the income estimate of GDP. You have to use the deflator that you've estimated from the expenditure side. So if we take then and of course the growth of nominal income and expenditure never balance in any country's national accounts. So if we unless a very specific balancing procedure is put in place. So if we look then at what would happen if we took the income estimates, the value-added figures that are used by the Chinese government and deflated by the expenditure estimate, we would see that growth had come down by the middle of 2015 to just below 4%. So I think, and if you I haven't shown the chart here, but if you compare this to something like the market cakes in indicator, PMI indicator, you see that this type of the income and expenditure estimates fit what you see in these PMI indicators much better than the stability of the official estimates. So this doesn't mean, though, that I think that there's been bias in the GDP figures over the long term, because of course over the long term there are periods when imports are rising and periods when import prices are falling, and so what this method tends to show is that if you use the expenditure estimates, you would have got, during the big upswing of the Chinese economy up to 2008, growth would have been much higher than the official estimates. So growth gets underestimated in booms and overestimated in recessions. And of course, in part, that's a very large part, of course, that's a kind of an effect that is generated because China itself is no longer a price taker in world commodity markets, but it's a price maker. So that when demand is very high in China, commodity prices rise, and that means then that the basic estimate of GDP is underestimated. And so that I think is is quite important for the policymakers in China, because it really can distort their view of what's happening. It may be one of the reasons why you get much more volatile inflation in China than in other countries, because the estimates of GDP growth that you're getting are biased in a way that means that you don't take corrective action quick enough. So this then it really, the storyline that we had earlier, that there has been a recession, seems to me to fit much better with these alternative estimates of GDP than with the official estimates of GDP. And of course, if you looked at some of the provincial estimates of GDP, you would see and rework. It would be much more difficult to rework the provincial estimates of GDP on this basis, but there you would see some really negative growth rates. You've seen very low growth rates in some of the northeastern regions of China. With a reworked GDP deflators, you would probably have a much grimmer situation particularly in the old Rust Belt of China. So now, what do we think is going to happen then on economic policy? As Christian said earlier on, Chinese policy in the past has always been very reactive on the fiscal side, but now we're seeing that basically that type of there's now really considerable opposition within the policy establishment in China to following that route once again. And you're seeing the kind of two camps, the more left-wing, no reform, let's have more roads and more bridges, more debt. That's on one side. And on the other side, you have the people who are looking for reform. And I think that this actually can be put into groups of people as well. I mean, the side that is looking, that takes the more sort of populist line, has pushed for social reform over the past 4 or 5 years, more government spending on social affairs, and led the big debt expansion in 2009, 2010. That group was from President Hu, and the current representative of that in the Chinese Politburo is the Premier, Li Keqiang. The other side comes from the General Secretary himself. Now, what I think is significant when you see that there is considerable stress at the moment between these different groups in China. I mean, if you go back to September 2015, for the first time ever, the General Secretary decided on the composition of his personal bodyguard regiment by himself. This is the first time this has ever happened. Previously, the General Office of the Communist Party has decided who should be the bodyguards. Now, the problem for Xi was that the General Secretary, the General Office of the Communist Party, the previous person who headed that was an ally of President Hu. And in fact, the previous head of that office is now under arrest for corruption. Maybe you remember there was a very notorious incident with the son of that guy when he crashed a yellow Ferrari on the Beijing Ring Road, and crashing a car wouldn't have been too bad, but there were 3 half-naked women in the car as well. And that was pushed up for 6 months. So there you see that there are problems, one problem there. We see also that the president said, first in September he said, Beijing is not the house of cards. But then by March this year we've seen something very strange. A long 1,000-word document was put up on the internet from we don't know how, but it was signed by loyal Communist Party members, and it criticised the party's economic, foreign and domestic policies. And they even went as far as saying that Xi's life may be in danger. So you see that there is a very considerable policy struggle going on, and just last month the General Secretary reiterated that Beijing is not the house of cards. But he went on to say, there are careerists and conspirators existing in our party. So, I mean, that sounds a bit like the house of cards. Anyway, they undermine the party's governance. So we see that there's a conflict within the party, and that is coming out in how we see the economic policy likely to occur. And indeed, the main power base of the previous President Hu and of the current Premier, who are kind of the people who are likely more to advocate the debt relance type of policies. They all had their power base from the Young Communist League, and one of the first things that this year that in the budget was that the budget of the Young Communist League has been cut by 50%. So this is another main blow against the second faction in China. So I think then that we have the possibility that we are going to move into a period of more reform. Indeed, the article that I mentioned in the People's Daily just recently, where they said there would be an L-shaped recovery, the person who wrote this article said that one of the advantages of China was that compared to Western economies, that they would be able to take one step back to take 2 steps forward. And the one step back is clearly that they are for a major reform of state-owned enterprises. So, will they be able to carry these reforms through? Well, there have been some reforms already during the last 3 years, and one particular significant one has been in the agricultural field, where the long-term reluctance of many of the left group of people in the Communist Party to reform of land rights in the agricultural area has been overcome. And so now land rights are specifically split into three different categories. The basic land is owned by the collective, then the farmer owns the lease, which can't be reassigned, and then the farmer can also assign a management contract. So basically, they're in the process of introducing a kind of a privatized system in land. Also, there have been a number of other policies. We can cite public finance, some elements of monetary policy, and of course, in social policy, the abolition of one child. So, what should we be looking for in terms of policy in the future? Well, the first thing would be, of course, that the main ruling group in China is up for renewal next in 2017, and usually those the composition. Although there have been in the past fairly set rules as to how the Politburo should change, President Xi has quite clearly overcome a lot of the past rules in terms of concentrating his power. So we should be looking for who's going to move into the Politburo in 2017, and that's usually settled in this autumn, and so that gives you some when that's kind of settled and the rumours start coming out, you should have some idea of what the policies should be. And I would guess that you should have a much smaller role for the Premier, an even more enhanced role for the General Secretary, and a greater role for the reformers. And so the consequence is that if the reform group wins out, we should be looking for a much more controlled growth of credit and significant reforms in state-owned enterprises. What do I think the risks would be if this kind of policy scenario came out? Well, already employment is weak, and it quite clearly would get a lot weaker. And so domestic demand, which at the moment is is relatively strong year on year, domestic demand would be under pressure. And so I think then that there would be significant pressure, downward pressure on the exchange rate. I think that's the adjustment mechanism that could come in parallel to structural reform domestically would be to allow more capital opening and downward pressure on the exchange rate. So I'll stop there, and I'm sure there'll be plenty of questions later.
Alvin Luthal, thank you very much for the invitation to GIC, and thanks everybody. Okay, I'm going to concentrate most of the remarks on emerging markets, but also primarily in Latin America. And the question is rather, the choices that you make matter. And they're not only the choices that you make now, but the choices that were made a long time ago do matter for the outcomes, right? So the choices you make in the upswing do matter for what happens down the line when you have the downswing. But there are also other factors that are affecting all of Latin America in the same manner. Right? In any case, what we have is a world which is going to be very challenging for emerging markets. Growth in developed economies is greenish, it's not bad, but it's not great. Right? But all economies seem to be doing relatively okay. We heard of the US doing 2% growth, so it's an economy of 2%. Europe is not doing poorly, well, it's doing 1.5 or whatever, but it continues to grow, you know, and so on. What we have is actually slowing down in a lot of emerging markets. We just heard about China, where it's growing around 5%, or definitely below what people thought, 7 or whatever. We already knew that, right? Brazil in recession, you know, Russia stagnating or recession. So most of the emerging economies are not doing very well. In that environment, the only one that's doing relatively better is India, right? But I guess Mr. Hurd is more of an expert than I am in India, so if you have any questions, just please direct them to him instead of me. But talking and centering on Latin America, what we see is actually very diverse growth patterns. We see that the East Coast, the Pacific Coast, is actually doing okay in spite of the slowdown. Countries like Mexico, Colombia, Peru, Chile, right? In spite of the slowdown, they continue to grow, right? Less than they did previously. And remember, and I will focus on that, some of those are, like Chile, they are very important commodity exporters. So they had a huge negative trade in terms of trade shock. And in spite of that, they're growing. And on the other side, you know, you have the countries of the Atlantic, Venezuela, obviously, but not only Venezuela, Brazil, and even Argentina, in which the growth prospects are actually quite different. They got other problems. Growth is not their only problem. They have institutional problems, they have political problems, and in that sense, the choices that they made getting to this stage is what really is mattering right now. But before that, let me tell you, the environment has different factors. I think there are factors that are affecting all countries in emerging economies, and there are 3 of them which are the key. I would say Fed tightening, more than the Fed is global liquidity. You know, what the central banks are doing, that will affect all economies in emerging economies, and particularly Latin American ones. The slowdown in China, which we spoke about, primarily for several reasons, lower commodity prices, right? And obviously there are also domestic factors. And in all cases, or in most cases, those are negative for Latin America. In particular, the Fed tightening, raising rates in the US, or the slowdown in China, they both hit negatively Latin America. The lower commodity prices, it depends. It depends whether you are an importer or an exporter of commodities. For the major part, Latin American countries tend to be, or the largest ones tend to be exporters of commodities, and that's how we associate them. Right? But not necessarily so. A country like Mexico is not an exporter of commodities. There's one thing I want to say beforehand. When we talk about Latin America, it's kind of strange because in reality, when we look at aggregates of Latin America, we're only talking about 2 countries, almost only one, which is Brazil and Mexico. Those 2 account for almost all of Latin America's GDP. So we have to differentiate and speak about them individually, because if we just put them on, lump them all together, actually those 2 account for most of the GDP. But very quickly, I don't know why this wasn't doing the right one. Commodity prices, obviously, they had an upswing because commodity demand, which led to an upswing in pricing and therefore investment, and that led to oversupply. Once you have an oversupply, obviously, and then comes the slowdown in demand, what happens is prices collapse. And the collapse, however, was not exactly the same for all commodities. So depending on which commodity you were exposed to, your terms of trade shock was different. Normally we have focused, when we talk about commodities, we focus mainly on oil. But oil has had different dynamics than the rest of commodities. I think the supply story in oil has been very, very different, affected by a lot of other factors, geopolitical in a lot of cases, than commodities. While what has affected a lot of the countries is not necessarily oil. A country like Chile is very exposed to copper, and actually is an importer of oil. So the shock goes either way. In any case, when you look at Latin America and its impact, how commodities affect them, a lot of the commodity downstream is affected by China. So what we do is look at the composition, the combination of exports to China and exposure to commodities, and what you realize is actually it's very, very diverse. Countries like Chile export copper primarily, but they export a lot of commodities and mainly to China. Right? Same thing with Uruguay, Peru, or even Brazil, right? Different commodities. While countries like Mexico actually export almost no commodities, in spite of being associated as an oil producer, right? Exports almost no commodities, it's mainly manufactured goods, and tends to export them to the US. So its exposure to China is only indirect. while it does affect them. And when you look at the global picture, actually Latin American countries tend to be among those that are most exposed to commodities and a slowdown in China among the countries. Brazil and Mexico especially so. Sorry, Brazil and Chile especially so. Mexico, as you can see, is actually down in the bottom left, right down here, and it's actually very little. The exposure is actually very, very tiny. The other part is actually, yeah, but this is only commodities and exports and trade. But nowadays, what we're seeing in the economy is that actually market reaction and market exposure can be more important and drive more flows than anything else, more than trade. And in that sense, there are actually only two countries in Latin America. But in the reverse order. While in GDP growth and commodity exposure, Brazil is much more exposed than Mexico. When you're talking about markets, the market that is the most important, the emerging market more exposed to flows, to shocks, is actually Mexico. Because it has a really large weight in the global index, but not only that, it has one of the most, actually it has the most traded currency in the emerging world. So anything that happens in China may not affect Mexico through the traditional channels of trade and commodities, but it is affecting Mexico through the market channel. Particularly, it's not affecting the real economy per se, but it's affecting in a big way currency. And it's making the currency depreciate much more than others. To the extent that, if you look at what's happened since the beginning of the year, I mentioned that, and I will speak a little bit later about this, the fundamentals of Mexico are probably the best in the region given the environment. They have no exposure to commodities, their exposure to China is low, right? They did a very good program of reform, so you'd say, oh, great, this should be the most isolated, best behaved country in the region. But it's been the country whose currency has depreciated the most since the beginning of the year. Much more than countries like Brazil, which actually just had its president impeached, is in recession for the second year, likely to be in recession. Not likely, I'm surely to be in recession next year, right? And still, markets are affecting Mexico more than Brazil, but in a sense they're affecting all of them in the same manner. So markets are not differentiated between different countries, and that type of contagion is obviously having big consequences. In a sense, what we have is that these three external shocks, Fed tightening, Chinese landing, and the oil supply, they are affecting the emerging economies, in particular Latin America, through several ways. US dollar appreciation, right, which is a risk for those who have high corporate exposure and obviously high dollar debt. Capital flows, lower Chinese demand, obviously import and lower commodity prices, and its impact is very different depending on which side, what is your specialty, but all in all, actually, is hitting all of them negatively. And in particular, there is one factor, which is this last one, increased risk aversion, right, which works through markets that is affecting all of them regardless of the fundamentals. So, generates a lot of volatility, and that's what we're dealing with. Just to make the story short, just a little color up of how Latin America and other developing economies are being affected, and what you realize is that some countries like Brazil are actually affected by almost everything negative. So besides having an internal shock, which is domestic, which I will talk about in a second, the external environment for the region is not actually very conducive to growth. With the exception, right, of, as I said, Chile and Peru, fine enough, they are benefited by oil. If I only focus on oil as commodities, then you would say, wow, Chile and Peru are actually going to be doing very, very well. Wait, hold on, those two countries are among the most exposed to commodities in the region. It just happens that they don't have oil, but they do have other commodities, and therefore their exposure is very, very negative to China and other shocks. What are domestic factors? Right? What's going on? Internationally, they're all affected. So why is the market not differentiating, and how do we see it? Let me show you. The first story is that Latin America didn't do too well in the way up. Actually, it was the region that grew the least during the boom years. And funny enough, one of the countries that grew the least during those boom years was Mexico, which is the second largest in the region. However, what you can see is actually it hasn't suffered at all since the crisis, so it continues to grow. It's good, it's bad. And when we look at Latin America, I use consensus forecast here for growth patterns, even though I don't agree with some of them, but it gives you an idea of what's going on. And it's that some countries like Venezuela, Brazil, Argentina, they're in recession while others are growing between 2 and 3%. So putting them all in the same basket, you're making a big mistake. You have to look at each one individually. I say I don't agree with them because 2017 Brazil, look, it's almost impossible that they will grow 0.5. I wish they were going to grow positively, but it is very likely that they will have recession again going into next year. If you know, they have a lot of problems, among other things, they're trying to reduce their deficit, cutting spending, political problems. It's very difficult unless the external environment changes dramatically that will generate growth. But in any case, the outlook is like that. But this is nothing new. You know, this is like I think I presented at GSC several years ago, right? And these choices were made a long time ago. You had some markets, some countries who chose a pro-market model, and some markets that decided to choose a different type of model, which is an interventionist model, right? Those who chose a pro-market model, like Mexico, Colombia, Chile, Peru, I even put Brazil there at the time, seem to be doing much, much better. Right now, after the fact, you know, the pro-market model of Brazil would be somewhere in between, right? It's not clear it's a pro-market. I wouldn't put it in the same place or the same spot with Venezuela, obviously, but it's definitely very, very different from Mexico or Colombia, right? And those are the ones doing well. Those are the ones who have pursued treaties of trade treaties between themselves. They form an alliance, right, with the Pacific Alliance to promote trade. They have a lot of treaties with almost everybody in the world. Anybody who wants to have a trade agreement with Mexico, Colombia, Chile, Peru, they can get it. I mean, they have it with pretty much everybody. And the opposite is the case with Venezuela, Bolivia, Ecuador, and Argentina up till very recently. But, you know, Argentina is changing. The question is how long it will take to reverse the damage that was done. So it's a different question, right? But the different choices that they made between independent institutions, pro-market model, with a reform agenda, you know, orthodox policy making, and so on, in the way out, actually, it didn't matter too much, right? This was the whole idea. You know, there are a lot of countries. Venezuela and Argentina, we all said they were. This is also an old slide. We were saying they are following an alternative route, right? While Chile was non-quality, U.S. Mexico, Colombia, Peru were actually the ones that were following a pro-market agenda. But when we put this up, actually the countries that were growing the fastest were precisely the Venezuelas, that Bolivia is still doing well, you know, Ecuador, whatever, but it was mainly because of the terms of trade shock and not because of domestic. And the truth is that when the sun is shining, you know, anybody can ride a boat. But when the tide turns, you better have good fundamentals and you better know what you're doing. Right? And the problem is that they didn't, right? Another problem in Latin America is probably the diverging path is the corporate vulnerability, and that's one that has been spoken about quite a bit, right? This is not our analysis, this is analysis by BBVA research, which I like quite a bit. And what it shows is that corporate vulnerability, particularly in Brazil, but not only Brazil, is actually quite weak, and therefore that's another hindrance towards growth in the coming years. And when you combine that with the macro external environment, it's even worse, right? I just wanted to show that actually China doesn't look too good either. When you look at corporate debt in China, it's huge, right? Whether they can manage it, you know, they got reserves, there's a lot of discussion on that. But if you just follow indicators, it just blinks out. So, and that's a big question. Well, other countries like Indonesia or in India or whatever, seem to be looking a lot better. But same picture as before shows up. When you take into account the macro environment, countries like Mexico, Peru, Colombia, they tend to look a little better in spite of the shocks that they have and the shock that their corporates have had during the crisis. And finally, reforms pay off. And just to show you that reforms pay off, I decided to take just two graphs from Mexico. You know, Mexico implemented labor reform, energy reform, telecommunications reform, and whatever at the beginning of the Peña presidency just a few years ago, right? This is what's happened. Look at what's happened to the price of electricity, right, in Mexico. It's dropping, industrial prices are dropping, industrial price of electricity is dropping by 20%. That's making companies much more able to face the headwinds of the international arena, and they're able to compete in a much more aggressive way. But look at what's happening with our telecoms. The price index has dropped already 10%. It's a very recent reform. So you're increasing competition, dropping prices, which at the end mean more efficiency, and you can get a lot of this. So reforms pay off. They may not pay off the year you implement them, but they pay off in the midterm. Just as a summary to stop, I'd say that looking at where we are today, the way that Latin America stands is has a commodity shock and less favorable financial conditions. Those are the summary of the different shocks, either because of the Fed, because of China, right, or simply because of supply problems. And both of those cases, you have an economic and fiscal impact. And and additionally, you are having this orderly exchange rate depreciation, which initially some people would say that will give you an export boost, but in this environment it's not. What it's actually doing is generating uncertainty as to the corporate balance sheets and other things, so it's actually not as positive as our traditional models would have said, so it's actually more a negative, a drag, than a positive, right? Because it also is leading to adjustment in capital flows, which that volatility is not very conducive to investment. In some countries, with the exception of Mexico, you're having a pass-through from the depreciation to inflation, and therefore the country, the central bank has to raise rates. So you're raising rates in an environment, so monetary and fiscal policy have to adjust in an environment where both they have to very low growth, high inflation. So what do? You choose growth or inflation is the traditional dilemma in which you're always stuck and there is no easy way out. They've decided, obviously, countries like Brazil or Colombia to raise rates to prevent inflation, but that obviously is putting some pressure on the growth side and probably making the recession somewhat deeper. So how are the different countries? I would summarize saying Argentina is renewed hope, probably too soon to judge. I don't know where too much hope. I think these transitions take longer and they're not always as promising as they look. It's going to take a while, I think, too many years. Brazil and Venezuela, I put them together here, even though they shouldn't be, right? But it's institutional liability. I mean, Brazil, we just had a president impeached, we have a new president, we have corruption all over the place, we have the states actually in default. So institutional reform is crucial to make it grow. I think it might be good for Brazil. I'm an optimist at heart, so I think they're going to get their act done, so they're going to change things because of this, which is good. But Venezuela, no comment. It's hard to see where they're going. Colombia, Chile, Peru, they are at the crossroads. They have the fundamentals are okay, but the pressure to do other things is big. Why? Because their growth has slowed down, they have other problems, but if they persevere, I think they're in the right path. And finally, the last one is Mexico. Mexico is closer to the US than it is to the rest of Latin America. Right? To the extent that the US only grows 2% is a pain. Right? It's not very positive. However, the signs that we get from the US are not bad. We just got this week the increment in remittances from the US were 8% in US dollars, 20% in pesos. That doesn't seem like 2% growth in the US. If the remittances are going by 8%, that's pretty good. That means that labor market is actually quite dynamic. So in that sense, Mexico is not a commodity exporter, no pass-through, so the bank can do whatever they want. They've done the structural reforms. They have some oil exposure, particularly in their government. So the government, Pemex in particular, is a big oil exposure spending. But what to think about Mexico? If you ask me, or if you heard me a couple of years ago, I thought they should be growing by 3.5 already. Right? The dynamics, the fundamentals were there for them to be growing faster than what they are. They're growing 2.5. probably I would say probably between 2.5% and 3%, which is not bad given the environment, but they have the fundamentals to do more. What's going on? Probably part of it is explained by exchange rate volatility, which is affecting investment and other things. And the choices they made in the past, they're paying off. They're living with them now. I mean, the countries that decided to go for pro-market growth, they're getting the benefits now. At least they're getting the chance to make choices now in order to face the downturn. While the countries in the West, in the East, they don't have the choice. Venezuela, Brazil, they have no choices. The question is how will they come out of that? And I'll finish with this one, which I really like, and is that at the end of the day, we really don't know where we are. So it's hard to plot a way forward, right? Or a way out of the mess for almost any country, for those in the problem, when you only have a distorted picture of what's going on. It's better to have a picture with guides and you have nothing at all. But you have to be very cautious, not assuming that everything is there already in stone. Thank you.
All right, so we've got about 10 minutes for questions, short questions, please, and then you can attack them all at lunchtime. Questions? Right here.
All of the talks today involve statistics. One, Richard Hurd mentioned a bodyguard unit, and I was astounded by that. I wonder if you think there's really any probability at all of a violent takeover in China. Bodyguard units are not what I'm used to hearing about.
So can you repeat the question? We didn't hear you.
I am surprised by your mention of a bodyguard unit in China. And that makes me wonder whether you think there is any possibility of a violent takeover in China.
Well, of course, there have been rumours just of that, but then there are rumours all the time of this type of activity occurring. But I would say that it's not unusual for him to have a bodyguard, for the General Secretary to have a bodyguard. There's always been bodyguards. What was different this time was that it indicated that he didn't trust the choice of bodyguards that was being offered to him, and that he so constantly chose his own. So yeah, that seems to me to indicate that he does have some concern about a power struggle within China.
Okay, in the back.
On China again, I was just wondering what you think about the general opening up of China and whether that will take a step back in terms of both capital account and also migration from China at some stage when the Chinese are actually allowed to travel abroad. Will many of them leave the country to other more prosperous regions? So there was talk back in the crisis that growth of 7% in China would not be strong enough to stop social unrest really rising quite strongly. So it seems that we are growing much less than 7% now. So I just wonder on those points what you think in general.
Well, I think, first of all, would Chinese people leave? I mean, the only way really that Chinese people can move to other countries is through so-called golden visas. I mean, most countries won't allow migration but on the other hand, if you go to Portugal or to Malta or somewhere, if you buy a €500,000 property, you can get a visa. What would I expect if there is capital opening? I think the portfolio of Chinese investors is very undiversified, so I would expect diversification of the investment portfolio, just the same as you had in the UK after 1979. The process was very quick in terms of diversifying portfolio. And so I think that you would get capital out, you would be more likely to have net capital outflows than inflows. And I think that that could be one possible combination of policies that you could have during a period where you were introducing a large amount of structural reform that was lowering domestic demand, lowering employment. So you would policies that would generate a fall in the exchange rate would be could be ones that would be quite welcome to overcome the domestic weakness.
Here in front.
Yeah, thanks for the talks. Just one on the Chinese local government debt that was mentioned by Manuel. Is that, how concerning is sort of the level of debt to these? And if a government does run into trouble, what's the mechanism for dealing with it, and how robust is it?
In fact, there has been. This has been one of the areas where there has been considerable reform. The finance, for a start, the government has appointed a finance minister who is something more than a cipher. Generally speaking, the finance minister in China has very low status. But the current finance minister is a much more, a much higher status individual, and one that was associated under Jiang Zemin with reform in the previous, the one before last presidency. So the Ministry of Finance has pushed through a reform now in which the local government debt is going to be split up into basically three parts. One part where basically the debt has been used to create public service assets. That's going to be moved onto the balance sheet of the local government. And then those parts that can be turned into companies because there are specific their profit making, they will be turned into proper separated companies, and then finally there'll be a group of companies where the government will pay subsidy to the companies to ensure that the debt burden is paid. Now, so far, and then on top of that, the local government debts are going to be managed at the provincial level, so that Beijing can't control what's happening all over China. So it's deputed. Each province has got to look after to ensure that borrowing these constraints are met within its own province. So I think that the overall level of debt, the overall level of debt of local government and central government is not particularly worrying. I mean, it's of the order of 60% of GDP. It's not that high by international standards. What's been worrying has been the speed at which it's growing. And the speed at which it's growing has been such that it did need some corrective action. But so I think that essentially they've seen that there could be problems through defaults of some of this debt, and they've trying to put in place a mechanism for stabilizing the situation. So far, only one province has issued its plan, but every province is supposed to be issuing a plan for stabilizing local authority debt.
I think we have time for one last question.
Thank you very much for the talks this morning. Is it your sense, Richard, that the Chinese are losing some policy control, navigating through the conflicted waters that you described? And when you say that a sharper currency devaluation is a risk, do you have a sense of what sort of numbers and or what sort of period we're talking about?
In terms of the risk, well, in terms of if you look at what happened to the real effective exchange rate in China during the period up to the middle of last summer, over about an 18-month period, you had a very significant appreciation, around 15%. So if that were to, if you were to unwind that, that's the kind of magnitude I think that you try to unwind the kind of unwarranted impact of linking. That was of course during the period of the dollar appreciation. So they've said that they're going to move now to linking to a basket, but I think the risk is an unwinding of that appreciation.
Well, thank you all. We're going to break for lunch now. We have 1 hour. It's going to be in the room to my left, your right, whatever. I'd like to thank Strategas as our sponsor for the event, for providing the hall, the lunch, the sustenance, and the discussion. We'll see you back in 1 hour. Thank you very much.
I mean, it's got a lot of problems, but it's very, it's shown in the past that it's been able to respond, maybe not in a democratic way, but it's effective in the economic sense. It's a difficult one because they could have their own Great Depression, but then they may still be the global power in 4 years. Even if they do have a kind of US style serious shock to the economy. Yeah, well, this is the thing, how much this slow growth that people talk about, I mean, how long does it persist before the masses rise and create all kinds of social unrest? Yeah, well, so I think it's difficult because it wasn't that long ago that people were saying that any growth below 7% was too slow for China to put all its workers to use without causing lots of violent protests and stuff. And now we're at 4.5%, I just believe some of those figures. I don't know what's happening to the population, but I guess they're relaxing the one-child policy. Are you going through for the lunch? I'm not sure if there's any jackets or anything.
He, I'm sure they're going to be very well.
thought was that country. Anyway, they decided they could. I'm absolutely bloody good. Is it that I said the facts? I don't organise what the client, how the client is decided is on the basis of the we just won't wait for them. For a period of time.
We had an interesting thing about under pressure of the job, you develop a state of depression. The money so noble on you into the long account. So come Tuesday morning, luckily so they had nothing on the program, which is the other program sets. Yeah. I didn't find out. Very much a spare time activity for Mark. I've done almost nothing.
still deals with something like 6.
We can break one down soon.
Not a lot of money. The main thing is and it's scheduled to start this month. Scheduled. There's that phase of IHS work. It's a big work. I got it out from, we got an email from India, my aide saying, sorry, I haven't been in touch. Yeah, we're bearing in mind, I need to do so and so. Anyway, it's pretty nice. But what I'm saying, yes. And we've got it if they do it. And he said, I need to do something. I didn't quite understand. I read that and I thought, sounds you need more information. Because he was talking about needing to understand more about the market. Possible. Good. Well, I decided. So, this is kind of what I'll tell you about it. Just so you understand. Answering the bad boy. Well done with the Brexit poll. Go to the website. Can you see our which you can go to, you can see what other people, what other businesses said that day, or about me. So you can look at other reasons and at the same time filling out. I'm saying, if you haven't made up your mind with the OC, you said it. Otherwise, please can you. But what's so boring is 1% of the responses so far. Only 10%. And 70% are over 55. And what I'm going to do next week, later next week, is send out reminders. I was just complaining that Christine, this is so lost. Apparently we should accept it, which is a bit short to time. It's associated with that new summer plan to bid. And they provide that apparently they were short, not a very large one, it was a short delivery of e-addresses, which then
it's quite a lot of shortfalls, which is really going to say the populace that what they want at the end of the day is more than even like B2B. That's what the problem. Phil is very much, I think he's good. Everybody, they have their strengths and their weaknesses are so associated. His strengths to process, to write, is absolutely taking care, etc., etc., etc. And the weakness is that you sometimes can't see the policy fine. Because you've got to stop learning something like one. I'm sure you do. And one of the things Twice figures demonstrate low unemployment and enjoyment. Both relatively small. Hence, look, well, this year, the increase is probably greater than it was 10 years ago. The rate of growth, but the money economy sort of down twice as big as it was. So half the rate of growth is still reducing. How useful is this as a statistic?
There are
Good luck.
Thank you. Okay.
Take care. Well, you don't have it, haven't you?
Priorities, I like that.
Don't forget this 10-year unbelievable.
You're way too bossy.
if you think, you get a paradox. I do think want to push back. It's something which is okay, who's actually going out there for a couple of weeks? So as I said, Ian is taking a big project for it was the inside show, but that's where the project is.
Actually speaking to him on the stage is almost completely different. Yeah.
Okay, welcome back for the afternoon and final session of our conference today. So we're going to do a discussion to finish up on the topic of macroeconomics. I'm going to be joined by my two distinguished guests. First, Keith Wade, who is responsible for the economics team and Schroeder's view of the world economy. He works on asset allocation strategies and is also a member of the group's asset allocation committee. And then Rajiv Dewan, who wears a dual hat as a professor and a director of the Economic Forecasting Center at the Robinson College of Business at Georgia State University. So I'll kick it off, give you a few of my thoughts. I want to talk in particular about what's gone on with some of the productivity numbers that came up earlier this morning. Keith will go second and Rajiv third, and then we'll use the remaining time for any questions or items we did not touch on. So let me just make a few comments that I'll tell you what I've heard today. It seems to me like we have a world where China's growing 5%, the US is growing 2%, Europe's growing 1.5%, Japan's growing some small number, maybe 0.5%, something of that sort. And those numbers are somewhere around potential growth for these various different economies. And that's the world that we have to become comfortable with in the absence of some sort of policy, either a fiscal policy or a novel policy move on the monetary side. Helicopter money's come up a few times. So let me make a few points here. First, I want to start with the idea the US economy is at full employment, using that as a starting point, a base case. I'd say 5% on the unemployment rate, and we'll get the new number here momentarily. It was only 38,000 on non-farm payrolls. So expectations I think were 160, and the number was plus 38. Yeah. So and the unemployment rate, do we have that? 4.7. Okay. So yeah. Now remember the Verizon strikes in there as well, but that's not going to make that big a difference to that report. But with the unemployment rate at 4.7, if I heard that correct, so I'd still say that's a level of unemployment that has to be somewhere around the natural rate here. We're going to accompany that with an upturn in capital spending, that has a question mark on it, let me touch on that, and more churn in the labor market. And then talk about productivity, whether that recovers in the US, what that will mean for profits and wages, and what that could mean for the speed of normalization. So here's the unemployment rate. So it looks like we made a new low if the 4.7 that just came out would be applied to this chart. You can see with this dotted line that we'd add that historically we have to be somewhere around the level that seems normal, or it'd be hard to say this type of labor market experience is an emergency at the moment. Yet we have some settings in the economy, especially on the monetary policy side, that look like the dials are turned to emergency at the moment, like interest rates that are just barely above zero. So that's what is at odds here. What we are seeing is labor share of income starting to rise. So this is corporate compensation for the US, wages, salaries, and benefits as a share of corporate GDP. This is a quite autocorrelated series. In any business cycle, it really only has two distinct moves. You start a business cycle with a falling labor share of GDP, and in the second half, you end the business cycle with a rising labor share of GDP. So I would argue, given this chart, we've probably turned the corner here for this cycle. This does not mean it's the end of the cycle. If you look at the chart here, we have rising labor share characteristics in the second half of the cycle. So I think it would certainly say we're maturing in the business cycle, but it would say we have to think about how the economy behaves if it's at that full employment number, how the economy behaves if it is in an environment where labor is starting to take share. Early in a recovery, when unemployment is high, the GDP we generate goes to profits. Later in the cycle, when unemployment is low, the GDP we generate goes to labor. That's the environment we're at today. Now, what will help with the performance, with productivity, as the economy hits full employment, it would be some sort of capital spending story, some sort of capital deepening. The red line here is private non-residential fixed investment. This is our CapEx series from the GDP account. The blue line is a CEO confidence survey. So the point is business confidence has been key for capital spending, and this is terribly surprising. What's interesting is CEO confidence tends to lead CapEx by about 3 months, by about 1 quarter. And it may be starting to bottom. We'll get another reading this month, but I think this is worth watching. And what could be the story here? I think part of the problem has been, even though the domestic labor markets have been performing decently well, let's take today's number and put that aside for a minute. But if we look at some of the concerns in the big economies around the world, it's been hard for big companies, multinational companies, to have a lot of confidence recently. Every year, a large economy has had a large macro question. So 3 years ago, it was the U.S. and the U.S. debt, U.S. debt payments. We had the government shutdown, the sequester, the debt ceiling fight, the debt downgrade. So the question was, will the U.S. pay its debt? And the answer was, well, yes, probably the U.S. will pay its debt. But do I want to wait for the government to reopen before putting that factory in place? Maybe I do. And then 2 years ago, it was Europe and Greece, and will the euro exist? And the answer was yes, the euro will probably exist, but do I want to wait 3 more months for this Greek election before I build that plant? Well, maybe I do if I'm a big multinational company. And then last year it was, will China crash? Is this currency move indicative of a tremendous problem? And the answer was, well, China probably won't crash, but let me wait 3 more months to see if the currency that went down 2% is going down 20 or not. So from here, if we say the U.S. will pay its debt, the euro will continue to exist, and China won't crash, there's reason to expect this blue line to recover. We're also seeing more churn in the labor market. So if we look at some of the employment statistics recently, we've seen people move employed to employed. That's important. That's important partly because I doubt you quit one job to take a worse job. Whereas I think this is pretty unidirectional. If you're taking a different job, especially if you're voluntarily separating, this is a chart from the Job Opening and Labor Turnover Survey, or JOLT, that looks at how many people quit in any month. This has been trending higher. And the story I would tell is unemployment was very high coming out of this recession in particular, this last one. Got up to about 10% in the US. The post-war peak in US unemployment was 10.8% in November and December of 1982. So 10 is the highest number anyone in their working years would remember. And coming out of that type of situation, people took whatever job was available. And we probably, in that type of situation, had a poor match between workers' skills and tasks. What I think we're seeing now is more churn. In other words, we're doing a better job allocating skills to tasks. And that's a way for productivity to start to do a little bit better. So we have the capital spending side, or if business confidence recovers, we could see a little more capital spending. We have the internals of the labor market, which are saying there's more churn, so we have some reason for optimism there. Now, how much optimism? So I'd like to just spend a minute on this table. So there are 5 variables here. This top number is wage growth. Next line down is productivity, that's the green. The unit labor cost calculation comes out of those two, that's the gap between wages and productivity adjusted wages. Then below the dotted line, the blue dotted line, is inflation, and then the bottom line calculates the price cost markup. And if you follow the blue arrow down, look at the bottom chart, we're charting corporate profits versus that price cost markup historically. And the point would be that the price cost gap is going to explain a lot of the variance in corporate profits. Or if that price cost gap is negative, profits do poorly. If it's positive, you have growth. So to sustain the business cycle, when you have a rising labor share, you need productivity to pay labor and capital instead of labor or capital. And that's what we're showing in this table here. Now, the productivity growth rates for the US have been as high as 3% a year. If you look at the late 1990s into the 2000s, you have had periods where productivity has been very strong. If we look at very long periods, decade-long periods or so, it's hard to find numbers that are significantly below 1. In other words, even in bad decades, like the 1970s, 1.25 would be a low estimate for U.S. productivity. What's important to note, I would argue, is productivity has been about 0 the last 3 years. So, it's been about 0.6% last year. So if productivity can mean revert from 0 to bad, that's still going to do interesting things to the U.S. economy over the next year. Even if wages are rising, if commodity prices stabilize and inflation comes in around 2%, you could still generate a positive price-cost gap. In other words, there is a way for wages to rise and profits to rise if productivity can at least get back to some minimum standard that was achievable in the past. So I don't need the 3% 1990s tech boom type story to get the U.S. economy to work over the course of the next year. I just need the 1970s minimum standard of productivity growth. Productivity simply can't be 0. Again, that's where the economy would get into big trouble. So some mean reversion in productivity due to that capital spending story, some churn in the labor market can achieve a minimum 1.3% productivity growth rate. And you can see how 2016 would work out in that calculation. Now, why is this going to happen today? Another item that occurs at the full employment boundary would be you get a lot of employees asking for wage increases. So they may ask for wage increases when unemployment's high, you won't grant them if you're an employer. What's happening now is employers are seeing the requests come in, they're seeing minimum wage hikes go up. If we look at New York or California or Seattle, they're seeing large companies raise wages. They're saying, well, I guess it is time for a wage increase. But maybe I'll ask for a productivity increase as well. In other words, I do think there's some way to reverse what you might think of as the traditional causality here and say if employers are now getting wage increase requests that they have not gotten and taken seriously for many years, and they are going to take it seriously today, that's a trigger. That's something new this year that could help spark what has been latent productivity in the economy as well. So with this type of story, what is making investors a bit uncomfortable? I think we got that sense here today to some extent. I think it's the question of, all right, you can see how this works out, but are we going to make a mistake? And when the FOMC put out their forecast of 4 hikes back in December, that seemed slow, but the market said that wasn't quite slow enough. Forecast had to be downgraded. I think if we were to ask what is the zone of safety, how much could we tolerate, the currency is going to play a key role. And the dollar is mattering more to our models than it has in the past. So the zone of safety, as I see it, for monetary policy is to calibrate the speed at which you're moving such that you don't cause either of these feedback loops to kick in. And so far, I think that's what's happened here in 2016. So the base case relies on accelerating productivity, which relies on accelerating capital spending and continued labor market churn. That should work unless this risk diagram starts to kick in. And the way to adjust for this is to cross off the first domino, which is any sort of policy tightening, or use the currency as your speedometer. That's the way I think of it. The speedometer won't tell you where to go. You get to decide that. It'll tell you, are you speeding on that path? So if the FOMC tells us we are on a tightening trajectory, we'll respect that. Seems reasonable. How fast are you going? This is where I think the market can make a big difference. And if we see dollar strength, we've seen commodity weakness, in particular oil weakness. That's hurt high yield bonds in the US. A lot of those are exposed to shale because of what's gone on in the past 5 years. If high yield bonds don't work, stocks have trouble working because they compete for the same part of the risk spectrum. And this is where you'd start to see the saving rate rise, consumer spending weaken, and you'd have a pathway for transmission to trouble. horizontal channel, the international channel, is every time the Fed raises rates and the dollar strengthens, China devalues, and that hurts emerging markets as well. So this, I think, is the speedometer that will tell us whether we're in the zone of safety or not. So if our base case is for improving productivity, there's a way to get wages up and profits up. This is the risk case, and as long as we respect the bond market and the currency market in our policy choices, I feel that that trajectory we laid out, where we have China growing 5, the US growing 2, Europe at 1.5, Japan at 0.5, that should continue to be the base case going forward. So let me call up some of my colleagues. I'll turn it over to Keith, and we'll continue with the panel.
Thank you very much, Don, and welcome. I'm going to just run through some thoughts on the US economy, just following on from what Don's been saying. I'm going to focus a little bit more on some of the changes that have occurred in the US economy really since the global financial crisis. And one of the issues that we're grappling with at Schroders and in our investments is whether or not the global financial crisis has caused a permanent change to the US economy and the world economy, for that matter, which is going to impair credit transmission and monetary transmission mechanisms. So I'll talk about that. I'll say a little bit about the near-term outlook, and if we have time, maybe say 1 or 2 words about Donald Trump. So just sort of setting the context, the US is still the leader of the pack in terms of growth. Since the global financial crisis, each one of these lines is real GDP growth, and I've just indexed them all to 100 at the start of the crisis, which I took to be the end of 2007. And you can see the global recession there, all those economies tumbling away. And then the gradual recoveries that come through, and clearly the US has led the way at that. And you can see as we run down, you can see that the Eurozone is some way below. Of course, Italy and Spain still below where they were before the crisis. Japan, which was doing quite well, of course, has sort of stalled since they raised the consumption tax. So the US stands out in that respect, but I think also this highlights some of the problems for monetary policy for the Fed at the moment, because the cycle is so desynchronized. And it means that as the Fed, talks about tightening rates, it begins to see the markets reacting, and with the ECB and the BOJ going in very much different directions. And the dollar, of course, is the kind of barometer, if you like, is the factor that reacts. And that's obviously complicated monetary policy for the Fed considerably. I listened to Charles Evans earlier, which I thought was an excellent talk, and I was surprised he didn't refer more to the dollar, because clearly that is influencing their thinking, and it's sort of showing how difficult it is to be the leader of the pack and be the one who's raising interest rates when the currency reacts and then the emerging markets react, and so on and so forth. I wanted to step back a little bit and just show a chart we've used quite a lot, just showing the evolution of forecasts for the US economy. And I think this is quite interesting. It doesn't show economists in a particularly good light, to be honest. Let me just explain what this is. Each of these lines is the consensus forecast for GDP growth in the US for each year going forward. And it starts at 2011 and it goes forward 2012, 2013, etc. And what you can see is a very clear pattern that economists start off forecasting growth of about 3%, or nearly 3% for the US, every year, year after year. And then by the end of the year, it turns out to be about 2% or less. Now, I think it was Einstein who said something about people who make the same mistake over and over again. It's a sign of insanity. I don't necessarily want to brand all us economists as insane, but this does seem to be a repeated pattern, and it does, of course, raise questions about this issue about how the world has changed, and why is it that all that stimulus cannot get us back to a growth rate of 3%. And of course it plays to the arguments that we may be in a world of secular stagnation, that actually the stimulus isn't going to work, and we are now stuck in this environment of 2% growth. One of the reasons why people got more optimistic about growth in 2015, which is the green line, of course, was the oil price falling. And that was expected to deliver much more stimulus than it did. And I'll say something about that in a moment. And I'll also say something about some of what I think are the changes that mean that we're probably going to be stuck with a growth rate of 2%, even if economists will keep forecasting through. So I just wanted to say something on the near term in the US. And I think the story in the near term is quite positive, if only for technical reasons. I'm sure many of you are aware that there's this issue in the US with the GDP numbers, that they do seem to have this residual seasonality in them. We ran a very simple test. If you seasonally adjust the seasonally adjusted GDP numbers, you'll find that you get a pattern, that there is a residual seasonality in there. And this chart just simply shows you actually the averages of the last 5 years and the last 30 years of the data for the first quarter compared to the second and third and fourth. And there is a very clear pattern that the first quarter is always weaker than the second. You always get this bounce back. And it seems, if anything, that the residual bias, the seasonal bias, has got worse since the global financial crisis, which may be sort of linked into what happened with Lehman Brothers in 2008. But what we're seeing, of course, is that the data, true to form, is coming through much better again. We are seeing better retail sales, better consumption numbers, and so on. So, the economy does appear to be firming and improving again. But, yet again, we seem to have been caught out, as we have been every year, about the weakness that we had in the first quarter. The other short-term indicator I show is just the sort of good old ISM, and that's turned up and that's improving. And clearly, there was a bit of a build-up of inventory, not just in the US, but in the world economy, and that's beginning to clear. Manufacturing is beginning to improve. But it's a pretty sluggish recovery. We're looking at growth picking up to about 2%. It's probably not going to be much stronger than that. But with the revival in consumption, final sales are improving, inventory is dropping. So, the economy is looking a bit better. But one of the things that has puzzled economists, and I think was one of the reasons why those forecasts were wrong, was of course the oil price. This chart just shows you on the left-hand side the benefit to the consumer from lower oil prices in terms of the amount of income that the fall in oil prices is worth. And you'll see here it's the blue line on the left-hand side. Energy as a share of disposable incomes dropped from around about 5 to sort of 3.5%. It's like a tax cut, 1.5%. What we didn't really anticipate is that a lot of that tax cut would be saved. And it seems that when you look at the distribution across the income distribution about who benefits, a lot of it does go to the higher income households who tend to save, so it hasn't gone into spending in the same way. And then, of course, on the right-hand side, the fact that the US is an oil producer now means that a lot of the old relationships don't work, and that the collapse in the rig count, which I'm showing here, that feeds directly into capex in the energy sector, and that, of course, feeds directly into GDP, and that's been a big drag. And it was still a drag in the first quarter of this year. But there are some signs now that that's beginning to bottom out, and given the revival in the oil price, we may even see a little bit of a contribution coming through. Just coming back to the consumer, one of the things that I think is quite interesting about what has happened with the fall in oil price is that the consumer has spent quite a chunk of it, but they haven't spent it in the way that they might have done in the past. And what I mean by that is that this is from a study that JP Morgan did. This was a big data study. They have 25 million credit card holders, and they can actually track what they're spending their money on. And the way to read this is that for every dollar that somebody saves from filling up their car, they will spend 73 cents on other things. And all these bars are the breakdown of the expenditure. So you can see that actually it was restaurants and groceries that were the main beneficiaries of the fall in the oil price, which is why I've got this sort of rather cheeky headline, a lot of the money's been spent on food. But the serious point is that it's the service sector that's benefited. And so the boost to US consumption that we have seen this year from the oil and last year from the oil price falling. A lot of that's gone into the service sector, and of course a lot of that is domestic. So it's kind of stayed in the US economy. And the amount that's actually gone into increased goods spending has really been quite small. It's only about 6 cents in every dollar. And I flag that because I think that's important for the rest of the world, because that service sector is not the traded goods sector. And I think this also helps tie in with what we're seeing in terms of global trade. So, we've had a bit of an improvement in the consumer, but we haven't seen the multipliers coming through into trade. And of course, this has been very important from how we think the emerging markets in particular are going to perform. And we've seen this continued lagging from the emerging markets in terms of export growth. And I think a lot of that can be traced back to the way that consumers are spending in the US. It's very different from before the crisis, when the housing market was booming and debt was growing. People were spending a lot of money on goods and services. We all know that if you move house, you trade in one house for another, you end up spending a lot of money on durable goods. That multiplier seems to have disappeared, and we've been replaced by something that's driving the service sector much more than the goods sector, and I think that's impinging on trade. Very quick word on the Fed, on interest rates. I won't spend too long on this because you've had the expert before. I'm still quite puzzled by why wages are so weak in the US. I think if you look on the left-hand side, the unemployment rate where it is, for all its faults, yes, it's not picking up the amount of slack in the labour market, but it's still getting quite low. You would have thought the wages would have accelerated. I think that's still a puzzle that we have to resolve. But it kind of gives the Fed time. They don't have to react to the data, the recovery in the economy. The dollar, I think, is important as well. Again, the dollar can be a deflationary force when it's rising. It weighs on import prices. It does feed through to inflation. That change in the dollar means the dollar is more of a neutral factor today. You could say, well, that's a reason why the Fed should move rates. But it's been interesting in the last month or so, since the rate expectations began to pick up again. In the US, the dollar has started to strengthen again. And this again comes back to what I was saying about one of the problems for the Fed in moving interest rates in this environment. And maybe one reason why those market expectations that we were looking at earlier today are so low compared to the dots. The market's saying, well, in this environment, the dollar will do the tightening for you. You don't need to worry about raising rates. Well, maybe skip over that one. Let me just move now to this whole question about the credit channel. Don talked a bit about the productivity side. I want to talk a little bit about the credit channel and how it's behaving at the moment. And of course, if we go back to the beginning of the financial crisis, when Reinhardt and Rogoff published that very good study about this time is different and about financial crises, and we generally took away from that the recovery would be weaker. But it wouldn't necessarily be permanently weaker. There would be a point at which balance sheets had got repaired and people could go out and start to re-leverage again. And when you look at the leverage ratios in the US economy, if you look on the left-hand side here, you see the household sector, the big rise there, the dark blue line, the big rise in gearing in the run-up to the crisis and then the fall away. I would have been quite surprised if you told me about 5 or 6 years ago that the US household sector would have deleveraged as much as it has done, and that it's still not really showing any sign of really re-leveraging. That's really striking. Now, some of that deleveraging was caused by people basically defaulting on mortgages and handing back their keys to houses and so on. And of course, they've been scarred, if you like, by that experience, or they're finding it very difficult to get another loan. But it's still surprising that that carries on. I think when you look at the supply of credit, you do see these big changes. Of course, the banking system's much more cautious than it was before. And products that we had, like the home equity loans, have pretty much disappeared. You can get home equity loans now. But when you look at the flow of funds accounts, you'll see that net, people are paying those down. They're still deleveraging on those. That's on the right-hand side. And that was providing a tremendous boost to growth and consumption before the crisis. And that's gone now. It's not coming back. And that, I think, is really significant. The other factor is that although we talk about zero interest rates, in practice nobody actually can borrow at zero interest rates. That the spreads disconnect between the policy rate and the rates that are actually charged in the economy by banks, or the rates that you would pay on credit or what have you, those are much higher than they were before. And these are a couple of charts from the IMF, and they both show that the credit spread, if it's credit to US households or a much broader measure, looking at general credit in the economy, the spreads have widened quite considerably. And certainly one way I look at this is to say that actually we've kind of probably gone back to where we should have been, that prior to the financial crisis, the spreads had got too narrow, that there was too much risk being taken, it wasn't properly priced. And so part of the adjustment that we're going through at the moment is actually to a world where you could say that risk is now being appropriately priced. And that's partly being forced on the banking system by the increases in regulation. But the price that we have to pay for that, of course, is that growth is going to be weaker as a consequence. And then on the corporate sector, you may have noticed from that chart I showed before of the different leverage ratios, the corporate sector in the US is actually re-leveraging. They're actually increasing their borrowing relative to their income. So there is re-leveraging going on in the economy, but it's not feeding through into real economy spending. It's not feeding through into capex. And I think it's very interesting if you look at the, again, these are from flow of funds, if you look at the capex and the dividend, the payout behaviour of the corporate sector, you can see there's been quite a shift that companies are favouring payouts at the expense of capex. And it's quite interesting at Schroders, we see a lot of companies come through, and management are always very keen to emphasise to us that, we're not increasing capex, we're going to increase your payouts and so on, because they think that's what we want to hear as investors. And then we say, well, what about the growth in your company? Aren't you confident about future growth or what have you? And I think part of the problem here is that the companies are being almost forced to increase payouts because shareholders are actually much more keen to get income now than they were before. They've been forced out of bonds and they're buying equities, to get income. And they want to hear the CEO saying, yeah, we're going to increase buybacks, we're going to increase dividends. So there's been a change there, and the companies that are paying dividends are being rewarded for it. The right-hand side is just a breakdown of what companies have been doing with their high-yield debt issuance, and really the point about that is that the thing that's absent is capex. It is on there, it's a tiny grey bar. But nearly all the money that's being raised in the high-yield market is either being used to buy back equities or refinance debt. So we've got this kind of financial engineering going on, which is behind the re-leveraging. Finally, the last comment I want to make just on the changes in the economy. I mean, we talk about the global financial crisis, and this has had some effects, and I can point out why it's maybe making growth weaker. But the trend towards weaker growth actually started some time ago. And somebody once said to me that everything always ends in demographics. And in many ways, the demographics are quite instructive. The populations are aging. Now, I'm using some UK data here, so I apologise for that. So we're talking about the US, but the demographics in the US and the UK are very similar. And what we found quite interesting is that, this is tying in with the credit channel again, this little chart on the left shows you the amount of credit use by different age groups. And you won't be surprised when you see the pattern here. It obviously picks up amongst the younger groups, and then gradually comes down as people get older and they get wealthier and they pay back their debt and so on. But of course this means that if you look at mortgages, you can see that there's a very clear pattern that as people get older they pay down their mortgages and the amount of mortgage debt begins to diminish. Now we use these figures in a model with demographics going forward. You can sort of track how much different age groups were likely to borrow, what propensity to borrow is. And it won't surprise you that in an economy like the UK, which actually has quite reasonable demographics, you actually end up with a decline in the borrowing rate because as the population ages, people move away from borrowing. And it will be a very similar story in the US, and of course it will be a very similar story in places like Germany and Italy and Japan, where the demographics are even more adverse. So there is this structural headwind going on that is actually weighing on borrowing. And I thought it was quite interesting that recently some of the banks in the UK have been announcing that they are extending their mortgage terms now. So I think it was the Nationwide who said that they would still lend to people up to the age of 85. Previously it was 75. So I think this is a direct response to this. But it'll be very interesting to know when you're 85 what kind of interest rate you would need to persuade you to borrow when you get to that stage of life. Okay, I'm not going to say an awful lot about Donald Trump's economic policies, partly because I don't really know what they are. It is quite difficult to work out. So he doesn't know either, so I won't venture into that territory. Except to say two things. One is that it looks like it would be an enormous fiscal stimulus if he followed through on all the spending plans. The other point is that when you look at the support for Donald Trump and where it's coming from, it comes from a group that could be called in many ways the sort of victims of globalization. And so, I certainly think we may be moving to a world where we see more protectionism, more tariffs, more restrictions on trade. And I think that is a concern, because one of the things that has been one of the positives through the global financial crisis and the recovery is that trade has actually remained quite buoyant, and we haven't seen trade wars. So I will leave it there, leave it with that thought. I hand over to Rajiv now, who's going to follow on with his comments. Thank you very much.
So I'm the last speaker, and I'm between you and a pint at the pub, right? So I need to get it done as quickly as possible. So let me see the technology. So I said I'm going to be the last one with so many people speaking over here. What are the topics? So the first one was, will the Fed hike once this year? And if you listened to my answer last Thursday, the answer was they won't. And then Manuel was at my conference last Thursday, and we were having a chat on the way back to the airport. And he convinced me that there would be one this year. And on Friday, when Janet Yellen spoke, she started to drop the hints. So I put in my forecast, in my slides, one hike this year, in September. But after seeing the number today, the headline, 38, and its components, I was checking it, they look pretty lousy. So even if you add back the Verizon strike 35,000 people, back to it, it's still lousy. Our corporate sector did not add much jobs. In fact, the loss in the temporary sector, temp help, which is a good predictor of the future growth. And President Evans this morning talked about investment, and that is actually, even taking out the effect of the low oil prices and the industrial facilities that have suffered, it's still pretty weak. Actually, it's negative. In the areas of tech investment, which is computer software, computer equipment, intellectual property, R&D. You combine them together, it's still pretty bad. So if you don't have investment today, how can you have jobs tomorrow? So the issue is about momentum. And then I said a subtopic I was trying to work on was the longevity of the current expansion, and I have a way about thinking about it. What can cause a recession in 2017? What would have to come together? Recessions are not that easy. Stalls and slowdowns are. But an outright recession takes a little bit more. So if I get the time and the chance, I'll get to it more in detail. So first is the art of the message. So I use comic strips to explain that. So there is this strip called The Pearls Before Swine. So Rat at the presidential debates, and he was asked, candidate Rat, if you could please sum up why you are running for president in under 50 words. Twitter takes 140, he wants it under 50. Press also wants that. He says, sure. And he starts. The campaign is about me, 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 me. 50 words. So then the press says to him, you can stop now. And he says, and God bless me. So that's the way politics is going in the US, and will have an implication for the economy. But let's go through some mundane things. I like to read the FOMC statement and correspond to the data over there. So it said in April, growth activity appears to have slowed. Okay, so numbers are mixed over there. They cited consumer confidence is high sentiment, which seems to be doing a fluctuation. If you notice, the consumer sentiment was 96 last July, it's 94.7 latest, but in between came down, went up. Consumer confidence has kept on declining. Now let me just give you a little bit of a background. The question asked in the consumer confidence survey done by the conference board is how do you see the economy 6 months ahead? The 6 months ahead is elections, November, the biggest uncertainty. Consumer sentiment from the University of Michigan asked the question to a more sophisticated audience, but lower sample. How do you see the economy 1 year ahead? That's after the elections. So if you're answering the number in May, you know a year from now in May, things would have fallen one way or the other. So you can explain that this is remaining constant and this is coming down. Okay. Vehicle sales, pretty good. Any number above 16 is too many cars being sold. Automakers like it, dealers like it, the Fed also likes it, the GDP also likes it, but it's just too many cars. Plus marketing works. Strong job gains, of course, we talked about job gains. The average is not looking that good with the latest month. And this was the one where all the reds appeared. They talked about business fixed investment, net exports being soft. That is there, that's the global economy. But look at the categories. I put down the structures over here. Structures unfortunately has the effect of oil wells not being drilled. That's been a big drop. So these numbers look pretty bad. If it wasn't for commercial construction of office building, hospitals, industrial warehouses, thanks to Amazon and all that, this number would have been even worse. Those categories grew by double digits, but this category fell by 30%, so the total was minus 10. Equipment, which is now computer equipment and transportation and industrial, fell 8.6, some effect of oil over here. But this is what I call the IP products, intellectual property stuff, that was very weak. Now, if you go back to the late 90s growth, these numbers would be solid double digits positive. That's the difference. So where is the investment? So where is the momentum? That's the issue. And that's why I said in this graph over here, this is the total investment, business investment, and that's negative. But if you take out the mining and wells, the oil sector, do you think it's trending up or trending down? You don't have to run any VARs or something. You can eyeball it and say the momentum is not there. So when we say, I'm also of the belief that it's going to be about 1.8, 1.9% growth this year. I'm also betting that this line will turn around. So all of us are praying for that. And this is where I put the tech investment and tech equipment and intellectual property. That's also coming down. So we're all saying, hang on, the hemorrhaging will stop and will turn around. And with the election season around the corner, with all the talks of the other things, why would the corporations turn around? Well, let me just give you some advanced indicators, which is like soft ones, in the sense like talking to students and other people. January, February, March, people in the tech area who graduated with a degree were not even getting a bite. They said things were like, nobody was talking to them. This is tech workers. Suddenly in April and May, they all are getting job interviews and have firm job offers. So something did stop in the US economy, not just GDP numbers, and something just did pick up too. So maybe that trend turned out to be fine, but that's just in the last month or so. So what's the definition of investment? Because Abby Joseph Cohen said, what we think of as investment, which is capital spending, sometimes discounted as operating expenditures, and she gave the example of Amazon Prime business. Since Amazon Prime decides to build this business at a loss, it's going to go as losses over there on the balance sheet, but it's a kind of 21st century capital spending. So I was surprised to find in a subsequent article that Amazon is the second largest retailer of clothing in the US. I don't know about over here in the UK. I don't know whether they even operate over here, they probably do. But I was surprised that stores like Nordstrom, Gap, Kohl's, Macy's, Target, which is typically you think about clothing stores, not Target that much, were smaller than Amazon. Right. So if they're trying to build this business, they take losses, and the NEPA accounting goes down as negative investment, it's actually an investment. So we have to be careful about the definition of investment. So one of the things in the US economy, and probably over here too, is the unicorns. We use the word unicorns. Companies that are privately owned startups worth above $1 billion. And the shares are not publicly traded. It's just private equity. So these are the unicorns where I say is where our millennials are finally working. So look at these companies. These are the valuations in billions. Uber, Airbnb and stuff like that. This is the funding they have raised in billions. And this is their revenues. Some don't even have it. And this is the number of people. So there was a talk about a year ago, 2 years ago, that this is the new bubble. Just like the late 90s. And I said, no. Late 90s was pure bubble. In the sense like, you took your name of your company, added the word .com to it, put it on the IPO market, you got a $2 billion valuation, no revenue, no employees. That was the technique. This is no revenues, but tons of employees and lots of funding. So the burn rates are very high for these unicorns, but hey, they're producing real wages in the economy. So I like it. Make them more. Okay. Now what's happened is Fidelity just marked down lots of the unicorns on his balance sheet. Because these are basically private valuations. They just did that in the first quarter. Before that, nobody was marking it down. Which means this is bad news for future rounds of employment, funding, and stuff like that. This is your future bellwethers of tech. So that's not looking that good. So how to track this segment's health? Because you can't get the valuations. Once in a while, a company will release a report saying we have marked it down. How do you track it? So there was a nice article in Wall Street Journal, a tongue-in-cheek one. There is this guy who sells ping pong tables to all the tech people in Silicon Valley. So look at that. When he was selling a lot more, this is that quarters over here. And this is the latest quarter. So maybe you can track his ping pong table sales. It's easier to track it than try to figure out what the valuations are. I'm just giving you a handle. Now, in March, they had a statement about global economy, global economic and financial developments, which they took out in the April statement. So what's going on in the global economy? As we all know, lots of stuff, but this was the growth in the S&P index in that October to December, and now year-to-date change divided in two parts, total versus before and after February 11th. So what happened in that time? And I can put it up this way too. I can show you four things: Japanese yen versus the dollar, gold price, S&P 500 index, and the oil price. Now notice one thing, so the index 200 at the starting of the year, oil prices drop a lot and they've recovered a lot too since then. Whereas the gold was beginning to come up, and after this point, the February 11th, that's the black line I put over here, it's maintained the gains. S&P, US stock market, was down actually 10%, and it recovered very nicely to be up a little bit. And of course, the dollar became weaker after that point consistently. So what happened? You can see it another way. I just get the scale. I put the 10-year bond yield, which was 2.2 at that point, and charted the yield so you can see more movements clearly over here. So what went on? And you can see that more in stock markets over the world. So from January to February 10th, this was the amount of bear markets, corrections, or just losses in the major stock markets in the world. And after 11th, it's all green. So what happened on February 11th or 10th? Did an economic report like employment come out that day? No. Anything else come out that day? I checked it. There wasn't. There's only one thing. On February 10th, Janet Yellen gave a speech, a semi-annual testimony, the February one, pretty early. Usually it's like the end of the month, but she gave it early. And she tempered the expectations that the Fed was going to move immediately or something. Once that happened, the Yellen put in action, you can see, like we used to say, the Greenspan put, this is the clear example of Yellen's power. All the markets move simultaneously into the positive territory. So, to understand the global economy, and I'm coming from the deep south, where typically a native-born American, his concept of a global economy is very limited. To explain to that person what a global economy is, I'm going to use some visual aids. So I'm going to start with something that you also probably know over here is Jack Daniels. It's a bourbon, but it's a Tennessee sour mash whiskey. The company is in Tennessee. It's headquartered in the neighboring state of Kentucky. So we're getting a little bit more. And that company's sales slipped 2% globally overall. And they blamed it on Jack Daniel's sales were hurt by a 16% decline in the brand's ready-to-drink products like Jack and Cola and Jack and Ginger. No red-blooded American has ever drunk or admitted to drinking Jack and Coke from a bottle. You mix one before the game, football game, which is not the soccer, but the American football. You drink 2 during the games and 2 after the game to forget it. But never from the bottle. But these drinks, remember, 16% decline in this category became a 2% decline for this company's overall sales. So where are these things popular? Who drinks it? You drink it in the UK? Jack and Coke from bottle? You know where they drink it? Australia. So I just took you from Tennessee in the deep south, via Kentucky to Australia. I still have to complete the journey. What's going on in Australia? And of course, this panel will know exactly. This is from one of my research papers, exports of selected countries to China, the top 30 partners, and only a few of them over here. And this is over the years. 2003 is important because in 2001 December, China joined the WTO. So a year or two after that. This is the recession year, global, and this is the latest data we have. So notice one thing, Australia had literally very little trade with China. And now, 36% of their exports went to China. And we all know what that is, commodities, right? Okay, so Australian health is now a function of Chinese health. Okay, so that's where I wanted to complete the picture. There's one more thing to go. We can look at some other countries. I mean, this is an audience that knows more about the global economy. But I want to ask, it's called the trick question. I want to point out both US and Germany don't sell that much to China. But I can tell you one thing. When China did the devaluation, the first attempt in August, the markets fell all over the world. US market went down about 5 or 7%. The German market was down 15%. Why are the Germans suffering so much when they only sell on paper 5% of their exports to China? Turns out they have factories in Brazil, other places, they make the cars, they sell to China. So market was punishing Germany a lot more than it punished the US. But the trick question is, I think you guys will get it over here. What does South Africa has that China wants? Sorry? Iron ore. That's Australia. People always come up in the US diamonds. Gold. Platinum, stuff like that, because that's the backbone of electronics. Our all cell phones, this thing stuff and all that, has now silver and gold in circuit board. After passing off to stop the lead contamination in the landfills from the old electronics. In 2006, it was mandated that you cannot use lead. Now you have to use silver as a soldering thing in the electronic circuits. So it's now silver and gold over there. So that's what they buy from there a lot more. Of course, in Angola, everybody knows it's the oil. Saudi Arabia is the oil. Kazakhstan is the oil. And of course, the old relationships are away. Look at Korea, from 3% to 26%. So when the Chinese sneeze, Koreans catch a cold. No, it's the other way around. And Japan. So this is, so I took you from Tennessee to Australia to China, now to complete the loop. It was the global economy. And of course, as President Xi Jinping is doing the house cleaning under the name of corruption, it has some unintended consequences. If you are seen doing a big banquet, big other stuff, is frowned upon now. Don't do an ostentatious one. So there goes the hospitality industry. If you are going to seal a deal with somebody in the accounts and all that, I've been told that, hey, you want to do a $5 million business? Bring some Rolexes. That's corruption in the West. This is called doing business over there. Now, if I remember it correctly, and you Chinese experts can correct me if I'm wrong on this one, but I read somewhere, maybe in the same magazine, that an edict was passed out that no Chinese official should be seen driving a car worth more than $80,000. So there was like, there goes the sales of Audi, BMW, and stuff like that. And you say, okay, all right. But you start thinking, what is the average wage, annual wage, salary of a government official? It's only $5,000. So they say, be corrupt, but don't be too much. So unintended consequences is that they have a self-induced slowdown in the consumption, hospitality. Now, something always makes money when everybody else is losing. So if you can't do conspicuous consumption, there's some other consumption you can do. So corruption crackdown a boom for lingerie makers. If you can't see it, you can't confiscate it. So now, is China the factory of the world? So in the US, you hear Trump talking about they're taking us to the cleaners. So it turns out, these were the top trading partners, right? With export minus imports means you're running a deficit. So China is running a trade deficit with these countries. It's buying the inputs. So who are they selling it to? Where do they make a surplus? They make it with Russia a little bit, followed by the US and the European Union. So basically, China is making the stuff to sell it to the rich West. This plus this is 50% of the GDP, 50% of the economy, whichever way you want to do it. And they're buying it from these other countries, and this is now the global economy. So when I started in this business in '96, this wasn't true at all. I started feeling that around 2008. I'm a lazy guy. It took me another 4 years to do the research paper to figure out these numbers. Yeah, there's no rush. I can feel it. I can adjust my model. Finally did it. So these people don't realize that because these guys are not buying that much, they are not buying this much, and it goes around now. China is not making the stuff to consume itself. Those are the minor variations. It's selling it over here. What's the health of the Europe? What grade would you give to the health of Europe? Would you give it a peachy? I come from a peach state. Would you give it an A+? Even with great inflation, you won't give it an A+. If you're in America, the word comes out F, because they do it with reverse rate inflation. It's somewhere about C. What's the health of the US compared to history? Barely a B. Whereas these things were at A in 2008, 7. So you can see that. So then people suddenly realize, oh my God, I'm the one who took the gas savings, shoveled it into my bank account, and I saved enough to go buy a shiny new car and a truck these days. I'm not putting into buying the stuff that China makes. Who makes the cars that are sold in the US, which are non-US manufacturers? It's Japan, Korea, Germany. These are the three that comes to mind. Is anybody left out? Michael? No. So, French don't sell any cars in the US, neither do Italians do a little bit here and there, and that's fine. So tale of two stocks. It also shows up in the stock market. I'm going to put two stocks over here in the last 1 year, Google versus Apple. And it should be very clear to you why Google is up 30% over the last 1 year and Apple is down 28%. This thing was done about last Friday. Why? Google is not allowed to work in China, has no revenues coming out of China, is insulated from China. Whereas, to some extent, whereas Apple has 50% of its revenues coming out of China and also produces most of the stuff in China. So, market says, you're not selling that many, you're having trouble with this thing, you're down, you're up. Now we can do it in the other stocks too, depending on how much you know about the company's operations. So Apple has cut back orders on its iPhones and the market is rolling it down. So the world is global, but this is too much. So I told you I did the research paper after 4 years that I was in Australia and New Zealand to present it at a conference. And I decided to send a postcard to people. Back to my office, to my parents, other people. So I wanted to get the stamp of New Zealand on a postcard. That's what you do when you go to other places, you mail it, you get a stamp that way. I sent it from Wellington. It came after 48 days. The earliest anybody got was the west coast of the US in 28 or 32. Now notice one thing. It's sent from New Zealand. What does the postage stamp say? Postage paid Brunei Darussalam. This thing was sent on a rowboat to Brunei from where it was airmailed to the US, maybe rowboated over there. I did not. I posted it in Wellington, New Zealand. And I'm having a stamp, electronic stamp, printed paper stamp from Brunei. This is how Sultan of Brunei makes money. So when I put up a macro model, this used to be the old macro model of the US economy. You have the US consumer, that's the big kahuna. You have the stocks in the bond market. This is adjusted for the 90s. Investment, Federal Reserve, commodities, oil. Americans are morbidly afraid of the next Arab oil embargo that they think will happen any day. Still, if you are an economist above my age. So here is the politics, here is the Europe, the biggest trading partner of the US, and here is the ECB. Okay, that's the standard traditional model. But now, because of China's rise, you have to put in China, works to the commodity market, emerging markets, to the stock and bond market. This guy doesn't care. He gets his product in Walmart and Amazon made in China, but the financial flows are over here. And that's what matters. The next thing is, you used to have the problem of Brexit. So I say to the US, thank God for our Greek brothers, cousins. We are the cleanest dirty shirt in the laundry basket. Because all the money, whenever they threaten to leave, the money comes over here. I was able to refi my house in 2011, but the rates fell so much because of the Greeks thinking about leaving, and it was enough to refi. And I just refied in 2009, within 2 years. So interest rates have been kept low, kept the boom of the refi going, and so the consumer can spend. Now this is morphing into Brexit, and we have heard enough today. Let me make a prediction. Without giving you any numbers, I'm going to tie two things together. The margin by which the Leave campaign will win is the same margin by which Trump will win the US presidency. Same margin. Then we have another friend of the US, as I call it, Putin. He scares Europe, money flows over here. I'm just looking at the flows. And then you have Japanese central bank representing the other central banks over here. Now, the reason I put the Japan over there is that in 2014, they explicitly told their pension funds, they have a rule, that instead of having 60% of your money in the domestic bonds and stocks, you need to reduce it to 40% and you can go more abroad. that was a boom of money coming out of Japan into the rest of the world, looking for higher yields. So that matters now, what the central banks do in the rest of the world. This is what I call, and I want to show you. I look at the revenues. My philosophy is that if your company is not showing profits, you have too honest an accountant. Get a new one. Enron and WorldCom showed us how profits are manufactured. So I like to look at the cash. Where is the money? So I was putting up 30 companies in the Dow Index versus Apple. Now the reason I put these companies over here is that these companies are global operations, half of them, significantly. And so they suffer from currency fluctuation. So dollar was very strong in 14 and 15, so that affected their revenue growth when they brought their operations back to the US dollar. But Apple doesn't have that issue. Apple produces in China, sells in the US, so everything is in practically dollar terms with minor fluctuation. So Apple did not suffer over here in that period of extremely low negative revenue growth in the US. It was showing great, and now for the first time in the first quarter, it had negative. So that tells me that the global growth, US growth, ain't what it's close to being remotely. Whatever the number was over here is really less than that over here. Okay. So I like to follow this thing so maybe we can track it too. Now the next thing is the Fed political analyst. So this guy says, he's a street guy and Wall Street person, he said, I do not agree that they will take up the race this year. It's election year, wild year. And I put up what kind of a GDP numbers the Fed will have before its meetings. Now, for the September meeting, they will have the second quarter GDP, but in November and later on, they won't even have the third and the fourth quarter. So, but they will have only this data. So for them to move in July or September, they will have this data, plus the employment numbers better be on average at least 150 in the next 3 months for them to move in September. And given the momentum the way it's playing, it's going to be tough. The other thing is that he said, never forget that the Fed is a creature of the Congress. It has to keep Congress happy. If you are the Fed, you can have the president get angry with you, but you cannot have Congress get mad at you and take action. So what's happening in September? All the congressmen and 1/3 of the Senate people are running for re-election. They're going to be out in their districts, canvassing, looking for money, doing the things. The last thing they want is somebody doing a radical move back in DC. So if you believe that, we'll move in September. Then comes December. Would they have the data? Not much. So the earliest was, my forecast was that last Thursday is going to be March, which I changed to September on Friday evening, which is in the slide over here, but I'm changing it again right now looking at the employment numbers. I'm looking at the probabilities in the market, and the market doesn't think June is there, and it has the other numbers for the other dates. Now, notice one thing. My rule of thumb, if the number is below 60%, it is pure noise. Not 50-50. It's got to be 60 and above for you to take that outcome more seriously. So this one says no hikes. Latest one I had May 31st. It's beginning to creep up, but it's still below the 60 level. Now, other thing I look at is the 10-year and the 2-year bond. Last time they moved in December, there was a robust recovery in the economy, stock market, not GDP. And the 2-year bond went up 50 basis points in the span of 3 months. So they moved. This time, the 2-year is only up about 15-20 basis points. This is not predicted. If this keeps on rising another 20-25, you can get September. I'll change it. The 10-year is basically saying you're not going anywhere. But that also depends upon the flows of capital from the rest of the world from the other issue. So it can contaminate. Anyway, other thing is, if you look at the S&P indexed to 2012, 200, and the periods. This was the when they were buying, when they were finished the tapering over here. So they were still accommodated. This is when the tapering ended in October 2014, and this is the movement since then. This was the deathly last August, and this is this January's devaluation attempt by China. Beginning. Has the stock market gone anywhere? What is the one thing that the Fed clearly was able to affect? Your wealth portfolio. Right now, so is it part of the consideration is going to be an issue? So forecast 140 characters or less. I'm going to channelize one of your famous detectives, Sherlock Holmes. And I'm going to say, momentum, my dear Watson, dictates one move in 2016. Cross that out. Okay. And if markets cooperate, you saw the charts on the QE and that thing, moves next in March 27. I need the stock markets to behave, just not go down south, just remain where they are and they will do. Okay. Now, these are the numbers. We all have this prayer in there that the investment takes up. Okay. And my thing is that investment is a tough cookie. Why would it pay? Given all the things. So, this is my numbers, which are much lower than the FOMC. Now, Trump made a statement in early April. I think we're sitting on an economic bubble, a financial bubble, and we're going to go into a massive recession, but if you elect me, everything will be fine. To which they were looking for a quote. Somebody said, nobody can predict what the stock market is going to do. I cannot predict the stock market crash, or I cannot predict a recession. So if it happens in the stock market, it has to be from some non-economic reasons. You know who said that? Younger version of me. This has been my philosophy for 20 years. I cannot predict the stock market, so I can't give you that recession. So that's why I channelized, I remember the movie based upon your other character, Detective Hercule Poirot, Murder on the Orient Express. So if you remember the novel or the movie, this is a detective. There are 13 suspects, 12 are guilty, and 1 is not. Okay. So what would it take? So I call it Recession on the Global Express in 2017. And I'm the detective, and these are the other things. So let me give you a list of who they are. List of suspects. So this is your, basically, whatever is bothering you at night, that's probably written over here. Brexit, China slowdown, Venezuela implosion. Venezuela is the number 3 provider of oil to the US. Nigeria used to be number 3, Nigeria has gone away. We don't buy much oil from Nigeria anymore. We have reduced our oil dependence on Saudi Arabia, Nigeria, other people, kept it same for Mexico, and guess who are we buying the oil from right now? All these leftovers gone to Canada. Okay. But Venezuela is still number 3. Same amount we were taking 10 years ago versus now. So that's why it's in the list over here. Stock market malaise, consumer confidence, you have all this thing, you have the Mideast politics, Fed's inflation battle, populist election, all these things. The only one I put over here in blue is the aging of the expansion. The idea that it's been 7 years since the last recession, it's probably going to get to the natural point and it's going to be in trouble. That I'm ruling out. I'm not going to go through all the calculations because on the computer, on the model, I can create any scenario, any which way I want. I was trying to see what will make it work. And this is what I found. These 9 things together, 10, collectively together, have to come in a certain sequence, will put the economy into a stall, not even a recession. Okay, that was my analysis. What are the other 2 that's going to cause the recession? The other 2 that left over is facilitating a populist election that leads to trade wars. I use the word populist. You can say Trump, you can say Bernie Sanders. Potato, potato. Okay? The only difference between Bernie Sanders supporters and Trump supporters, Bernie Sanders and Trump supporters, they have the same agenda, except that one says you are a billionaire, so you must be bad. The other one says I'm okay with it, I'll get it done. But they both have the same thing. Fed gets paralyzed. This has to happen. Trade wars begin. Fed gets paralyzed with QE fatigue. No calories coming, leading to capex nosedive. That's when you have a recession. So let me show you. Now Warren Buffett was asked at his annual meeting, are you worried about the Trump presidency? And he said, that won't be the problem. US business will go to continue. We lived through all kinds of price controls and all this stuff. We come out fine. Presidents don't matter. It doesn't matter. This is what we call feel-good sales pitch. Don't worry, everything is fine. Trust me, I'm running a big conglomerate. Don't you think I would know about these things? Now shut up and let me go on. Now, here's the thing. We all, just global interdependence in the meeting, so I put up, this is global world trade. This is the 2009 recession in the world economy. And this is the world view. So for me to produce a recession, I need to drop this trade. And I need to have a trade war or something which drops it to minus 5%. So you can look at from here, given the previous thing, the working model, statistically, 5% drop means a recession half as bad as the last one. Okay? But what if the trade war is more significant, not just China? US runs a trade deficit, its top 12 trading partners, including UK and India. So how many people are going to pick up the fight with? Gotta be the issue. So if you pick a fight with everybody, let's say drop it minus 16, then you get a nasty one. Okay. So I'm going to give you a forecast about US election. I think I have it over here. No, this is what the market is saying. This is the Iowa Electronic Markets Exchange. You can check out the betting probability where people are betting. It's going to be Democrats or Republican as the president. And you can say they were neck to neck. Then the Democrats open up a lead. Trump not over here. And then Democrats are coming down. Trump is coming. It's getting to be 50-50. What are you going to do with this probability? How are you going to run your model? You need certainty, right? I'm going to give you one. I'm going to give you my forecast. Right now. A year after Trump is elected. Okay. Notice the White House. Notice the Trump sign. He puts up the Trump sign. And then he says, I don't like it. It's too small. Make it bigger. Crazy. He still says, that's not good. Take it even higher. And then he says, thumbs up. So here's the problem. To do this thing, he needs the materials, cement, iron, other things, and workers from a certain country that he's been demonizing. And he picks up the war with trade with China and all that. So this wish will not happen. Won't have the men or the material to do it. So with that, I will end and we can all have a Q&A. Thank you.
Any questions from the audience, things we haven't touched on, or pictures we could draw for you? In the back?
Thank you very much. That's very, very interesting. Well, I've got a sort of more general question. Twice today, we quoted unemployment rates.
Unemployment in Germany, low. Unemployment in Japan, low. But what we know about both those economies is a low participation of women in the workforce. And what I'm interested by, I'm not an economist, I just would like to understand, for those of you who are, how important is using unemployment as a statistic to compare economies compared to the participation rate? Why is it that you talk about unemployment rather than participation? Is there a particular reason?
I'll give it a quick comment. One, I think when we look at the unemployment rate of labor, you could think about it like the capacity utilization rate that you would use for industry. It flipped over, but the idea is, are you in a position of slack or not? And so for a given participation structure, the unemployment rate as calculated will tell you, am I at a point where I'm going to create wage inflation? Am I at a point where I have to worry about corporate margins? So I think for that purpose,
the unemployment rate, if we think about it as the inverse of the employment rate of labor, would give us some indication of whether we're creating labor market stress. Are we creating conditions that would generate rising wages? And if you have an inflation target, you might care about that because it would lead to rising prices. So for that question, unemployment is important for determining the health of the labor market. Now, if you're asking, can we generate gross domestic product? I'd like labor force participation higher. If I have higher labor force participation, I will make more gross domestic product. If I'm taking a ratio of debt to GDP, I would like GDP higher, so I'd like labor force participation higher to share that burden. So I think a lot of times we are talking, as we are today, in the presence of monetary policy makers who are interested in inflation targeting, and for that purpose, the unemployment rate has some specific value. But if we're talking about can an economy produce more things, goods or services, labor force participation plays a big role as well. That would typically be thought of as part of the potential growth rate structure, and then the unemployment rate would have a natural number that comes out of that calculation. That would be my quick answer.
Further into this, how would you like it if Hillary appointed Obama to the Supreme Court?
So, I'm not sure he'd want the job, but he might. I haven't asked. The Supreme Court vacancy is important. I don't think 8 is a good number. You get ties that are answering questions that are quite significant for the country. The delay in appointing a justice at all is something that's important, not necessarily as much on the economic side as some of the social policies. But regardless, the politics of the administration are probably going to carry over to the Supreme Court. And I would say that's potentially a selling point for Trump if he is the Republican nominee. You could say, if I win, you have a person who at least will appoint someone who may be more in line with your social policies to the Supreme Court, even if I am not. I do think that's right. One in the back.
I wanted to ask a question about your global trade figures and the merchandise slowdown that we've seen to below the rate of GDP. I'm just wondering if you have any opinion as to whether it's a kind of transient slowdown. Europe's had quite a slowdown. You mentioned the housing market. Europe's one of the biggest merchandise traders, and so is China. Or if you think it's about this internal services phenomenon that you talked about. Just what is driving that kind of global trade slowdown, really?
Okay, yeah, well, I mean, with two things. First of all, the slowdown of the world economy itself, has brought down that rate of growth. But I think what you're referring to is the multiplier. I think Rajiv had that chart of GDP and global trade, and you could see very clearly that before the crisis, global trade always grew faster than GDP. And now it's kind of slowed down into line with it. Now, I think part of the story is the kind of goods and services that are being bought now are being skewed towards the domestic economy. That the service sector is getting the benefit of the boosts that are going through to consumption, and it's not flowing through to trade. But there are other things as well, because of course, I mean, we also saw from Rajiv's charts as well that the China trade, which generated a huge amount of global trade growth, I mean, that slowed down a huge amount. Commodity markets in particular, they were a big chunk of that trade diagram. China accounts for something like 10% of the volume of global trade. So the slowdown there has come through. And, going forward, I don't really see China really accelerating very much from here. I mean, the analysis that we've done, looking at the bottom up, if you like, of China, it says that Chinese growth should be about 5%, rather than the sort of 8 or 9 that they were growing at before the crisis. So the slowdown is permanent, and they will probably slow down further. 5% over the next decade or so. Well, that means that that part of the commodity trade and so on is going to remain, pretty sluggish. You will get rallies and, things will get oversold and so on, but it just means that we've moved into that world of weaker trade. And, that's before we get any trade wars, so, that could be an added concern on top of it.
If there are no other questions, then we will close the session. There's one more.
Yes, sorry. You mentioned that China and the USA will be slow, but how about India? What will happen in India?
Yeah, of all the emerging markets that we used to focus on, there was the whole term BRICS: Brazil, Russia, India, China. That the folks at Goldman Sachs came up with that nomenclature. India is one that seems to be performing a bit better. Brazil has had troubles politically and economically. Russia seems uninvestable. China is still growing but slowing. So I think there's some room for a bit of optimism, though the optimism was probably a little higher a year ago. Different budgetary items have come through. But I think it will face some of the same emerging market challenges that have been mentioned around the table here today. In other words, part of the problem for emerging market investors is that if the complex gets sold, people sell what they can, not necessarily what they want. And so if it's something holding in your portfolio, it may be taken along for a ride with some of these other emerging markets until some of the other issues stabilize just because of capital flows.
See, the Indian economy is still at the starting point an agrarian one. So if the Indian monsoon this year is not good, these growth rates will not be sustained. And other thing they are doing is they're also changing their standard of how they're counting the GDP. There's been changes, so they have done it only for like a year and a half or 2 years. But the previous data is from the old terminology, the new one is from the new one, and that's why the growth rates are looking a little bit too good. Okay. They're not fudging it or something, they're just changing the way they're counting this stuff. So that's going to be the one issue, but the biggest unknown card is how good will be the monsoon. The monsoon should have started hitting India in the last couple of days. If it gets delayed by a couple of weeks and it's not good, there goes the multiplier.
Timo?
Thanks. I love the wording of Rajel, which referred to aging of the expansion. That is something that it has been puzzling me as well. So usually when an expansion has been going on long enough, simply something has ended that. In the good old days, it used to be excessive inflation, current accounts, deficits, growing indebtedness, or whatever. But you never knew it beforehand, what it was. And so therefore, in a way, it was interesting to hear from the other speakers. Do you see any kind of logic that nothing can continue endless?
Let me just add one thing, Timo, to your question. I forgot to mention it, but Australia is now technically in its 26th year of straight expansion, broke the record of Netherlands' 25 years in a row of growth, which they had till 2008, which was a little bit bigger than the Japanese had it from the 70s to the 90s. And like on paper, if you believe the Chinese statistics, they haven't had a recession since 1990, right? So this phrase came from the question that was asked to Janet Yellen in a semi-annual testimony. Like, don't you think aging, this expansion is aging, is it going to end? And she said, there's no such thing like that. So that's why I put it on.
Maybe just add one thing. There's an interesting paper that San Francisco Fed did on this question, and they looked at economic expansions in the way that actuaries would look at people's longevity. And they found that the probability of the expansion ending didn't increase as it got older. So it didn't work in the same way as it does like for us aging and we eventually die. Expansions can go on and on. I think you're absolutely right. I mean, it was always inflation and global imbalances that would end those expansions, but in the world that we're being in today, which I think is still quite deflationary, when we have big capital flows, it's become a very different kind of system where it can continue for much, much longer than people think. And of course, the last expansion only ended with the financial crisis, so it was the financial imbalance that ended it.
Yeah, we know from history the longest expansion was 10 years in the 1990s, and I think looking just at time is tricky because, as I tried to show in my charts, I think there's a first half of the business cycle and a second half of the business cycle, and then there's the end of the cycle. So sometimes I think we focus too much on when is the recession versus have we shifted phases from the first half of the business cycle where we have a falling labor share of GDP to the second half of the business cycle where we have a rising labor share of GDP, because those two characteristics can be different. Even if we don't have the business cycle event that is the recession, there is still a business cycle event, which is this phase transition from what laborers and capital shares are doing in the economy. But I tend to agree, you don't have the recession event just because of age.
From an economic forecast point of view, do you see any protective factors to, say, mitigate against, say, sorry about the question, but to mitigate against, say, a major conflict arising if there was a collapse in economies and, that kind of, anything that is protective?
Well, there are 5 policies you might use: monetary, fiscal, trade, regulatory, and immigration. And the burden has been put on monetary policy around the world, partly because it's quick. It can be decided by a dozen people in a room with the printing press. Fiscal policy has to be decided by several hundred people with a larger vote, either Parliament or Congress typically. But there are other options. Trade policy, if anything, we're potentially moving in the wrong direction based on some of these electoral decisions. Regulatory policy has tightened, probably doesn't ease a lot, and immigration policy is slow moving anyway, and again, maybe going backwards. So it really would come down to monetary or fiscal, and I think it is clear fiscal policy may have to be the policy of choice should there be a shock.
I just wanted to ask a question about the productivity and to get your ideas, trends that we've seen in more recent years. And this whole trend where you talked about, the likes of Uber and Airbnb and all these new technology companies that are sprouting up. Because these new apps and these new inventions seem to be helping people in terms of spare capacity and generating income, which they might not otherwise have been able to do. I'm just wondering how much these new technologies are disrupting the productivity numbers and because it would appear on the one hand that we are becoming more productive, and there's a lot more facilitation of general people being able to make money from various different means through these apps. But then a lot of the statistics will be telling us that the productivity has declined in a lot of these Western developed economies. And I'm just wondering whether there's some sort of measurement issue at work there or whether it's something different.
So a couple of comments. One, nominal GDP is measured reasonably well. When we get to productivity, we're talking about how we split that between units and inflation, real GDP and inflation. And if productivity is somehow stronger than we think, then we have to also argue inflation is lower than we think. Just given the math of this. So I have trouble arguing inflation is a whole lot lower than estimated. It was already estimated to be very low. But if we look at something like the market-based deflators, which are just what they observe in the field when the surveys are done, they're not wildly different than the headline numbers, which do have imputed prices and adjustments. Still, so there may be some scope for measurement there, but it does seem to be relatively small. There can be some problems with tech deflators, these type of things. But if nominal GDP, which again is just adding up dollars, that we can do, is slow as well, I think there's a broader problem. And so my take would be some of these companies, like you mentioned, are good at maximizing existing resources, but that dislocates the worker who was the taxi driver, or who was the hotel worker, or who was the carpenter, or something of that sort. And I think part of the challenge today is those workers don't know what to do exactly. As you get fired from your taxi driving job, where do you go next? Well, this has happened over the course of history. Half of the labor force used to be employed in agriculture. Nobody's employed in agriculture. Very few people are. So few people are. The headline number we're all talking about is non-farm payrolls. We don't even count the farmers anymore. So that's okay if the workers who are dislocated find other productive work to raise the living standards. I guess my concern is we may have too many workers going into the luxury part of the service part of the economy that's less productive. And so you have part of the economy getting more productive, but those dislocated workers wind up down the street in a job that may be down the value chain, or at least sideways to an extent, that we are not making aggregate progress as we would like to see to raise living standards.
Maybe just add one thing. I mean, I agree with what Don says, but I think the challenge of the measurement is actually really significant in that, you know, if you take something like an iPhone or what have you, and how do you account for that in terms of pricing and the inflation deflators? And, you know, because you've got a product that's a phone that's also a camera, communication device, you can use all these different apps on it. You know, somebody recently added up all the things that an iPhone does and worked out what it would cost to buy all those things about a decade ago, and came up with a figure of about $70,000. Now, you know, that's an illustration, but it gives you an idea of the challenge of trying to price these things. And then we go through the disruptive phase, and we end up with everybody using Uber taxis instead of the old style. And, you know, the old style taxi drivers go off and do something else. But we're still probably better off, because although we're still taking taxis, Uber is more convenient. So how do you measure the benefit of that to the society through the GDP stats is extremely difficult. I think there is a huge measurement issue at the moment. It's probably more than the sort of 0.25% or so that people have said that's the difference in terms of the deflator. I think maybe more than that.
Yeah, and I guess we just have to be careful not to confuse consumer surplus and productivity in this market. I agree people are probably happy. Yeah. I'm just not sure the level. The difference would be, I'm not sure, no matter how many free things you do, let's say you have a lot more blogs or Wikipedia or these types of things, you won't pay back your student loans, or it won't pay back your auto loan, or it won't pay back your credit card. So depending on what we're doing, which question we're asking, ratios of, say, debt to GDP still may be appropriately calculated, even with some measurement issue on utility. I think we're getting the hook from our boss.
Well, I'd like to thank everybody who came, especially those who remained all the way through. Once again, I'd like to thank Strategas as our sponsor for the event. Remind those who are interested that we have an event in Helsinki on Monday if you want to take a quick plane. We have an event in Victor, Idaho, outside of Jackson Hole on July 14th and 15th. And then we'll be returning to Dublin and then Madrid in late September and early October. You can see all of this at www.interdependence.org. My boss, Jill Fernito, from the back is looking at me because I say .com almost every time. Thank you very much. We've had another on-time arrival from GIC. Finishing up before we were supposed to. Thank you all for coming. We hope to see you again soon.